Governor, you want to start us out? It's 8:02 if we got everybody here.
Sure. Good morning, everyone. And it is 8:02, and I see that we have a full quorum. It is hard to see across the room, but Mr. Treasurer, uh, Director, it is a good time to start your meeting, sir, and I'll pass it to you.
Mr. Chairman, I do have one question here.
Sure.
It does appear on this agenda that it says information only on each of the points. I've always taken that to mean that there's no motions on the items. I mean, obviously, we've got this IPS at the end, but I assume that's you're bifurcating sort of the info from formal action, which I thought was maybe where you were going with this, but in absence of any briefing, I was a little confused on that.
Mr. Secretary, in past, we've had these information meetings as a work session to be able to take time to walk through the recommendations, which we would then formalize at a later meeting with a motion and an approval.
Thank you.
Thanks. Mr. Treasurer.
Thank you, Mr. Governor. And Mr. Governor, I apologize for the acoustics and the audio visual there on the Zoom in this room. From time to time, it seems that we've had folks that haven't been able to hear what the proceedings were on the table. So I'll try to make sure that this TV is really close to me. We'll try to make sure that we know when people want to speak, and hopefully everybody can hear each other. But I'd ask everyone to necessarily, because we got a lot of folks on Zoom, make sure you're very close to your mics so we can hear them. And Director.
Mr. Chairman, just so that we have it on the record, I want to make sure that it's in the minutes for today that today's special meeting has been properly noticed. Thank you.
Thank you. Okay, so Mark's just called this thing to order and some opening remarks. And what I'd like to do now is continue opening the joint session of Slib and IFC. As the Secretary said, this is for informational. So we want to get all the information out there so people can understand it, and see where we're and what we're doing for asset allocation. It's perhaps the most important thing that we do is asset allocation. I've heard the numbers anywhere from 80 to 95% is how you make your money is in what you buy. It kind of makes sense that if you don't know what you're buying and you don't know why you're buying it, then your performance might go down. And I want to I guess call attention to the team and to our CIO of the success that they've had over the last 6 years. I think we've had 6 years of beating the benchmark, and that's outstanding. And thank you, CIO Fleming.
Thank you, Mr. Chairman. Patrick Fleming, CIO for the Treasurer's Office. Thank you, Mr. Chairman, for your kind words. Thank you for members of the board. Ohio gozaimasu to the governor. I know that he was not able to attend today, but I'm glad that he's here. Just a quick overview. One thing I wanted to talk about is 1 year later, what we talked about at previous meetings, specifically with the IFC. I believe last year's meeting was canceled, but a year ago, we were of the view that over 12 to 18 months, we were thinking that it was likely greater than 50% probability that we could go into a slow growth / recession in that period. So here we are 12 months now. Over the next 6 months period, that's kind of where we are. The reason being is because of the interest rates that we were seeing, there was a lot of stress with many highly indebted companies, and that without the Fed dropping rates precipitously, it would be very difficult for some of these companies to refinance and do some of the things that they were doing. moving forward a year later, we were correct in that we did think inflation was going to be more sticky and the Fed would be less reluctant to drop rates. And so we were correct in that assumption, but we also highlighted when assets are extremely expensive, any kind of exogenous shock can have a larger impact on asset classes. And so now that we come through with President Trump's tariffs and the outlook, that is kind of the shock that has hit the market. And the big thing that we're trying to figure out now is whether or not we go into a recession over the next 6 to 12 months or not. And that's really up in the air. It's uncertain right now what's going to happen. But one thing, just looking at our asset class and performance is one thing that's kind of, I think, easy for all of you when we do see these tariffs of kind of to see what kind of impact we'd have is just a basic rule of thumb would be that for the effective increase in tariff rates that the president has proposed, let's just take a 10%. Most of the pundits are saying 10 to 20%, but let's just take 10 for argument's sake. A 10% increase in the effective tariff rate would result on average in a 1% decline in growth, GDP, and a 1% increase in CPI. So the rule of thumb is for every 1% effective rate, it's 0.1 GDP decline, 0.1 CPI increase. And a lot of people are saying, well, energy prices are down and so forth. The Fed looks at core PCE, so they don't even look at energy. Food and energy's out, so don't even think about that. It's the other part of it. So with that then puts us in a situation that if in fact this continues on, that we're right on the precipice of going into a recession, and inflation would be much higher, kind of in the 4 to 4.5% level. So we're talking pure stagflation environment, which is really difficult. And when you're looking at our modeling, the worst case scenario for this fund is a recession, 10-year treasuries up 100 basis points. This is just a basic model, just so you get a sense. And the dollar down 10%. So that would equate to approximately $1.6 billion loss to the fund. So that's kind of the worst case scenario that we're looking at it. 20% drop in equities, 100 basis point increase in 10-year treasuries, and a 10% drop in the dollar. Now, to mitigate that, as you know, we have positioned the portfolio because we were thinking that this is highly likely, very conservatively. So, we still lose money, but on a relative basis, we think that we would do very well with our modeling, with our managers. We do not believe that the managers would lose that amount of money because of the way we're positioned. Our downside capture rate is really, really good. We're extremely conservative in the things that we're doing. So the models would say that we would lose that, but I don't believe that would be the case because of where we are. Now, if all of our managers, do something different than what they're modeling, but so far that has come to fruition. So that's kind of what our view is. So big picture wise, I just kind of wanted to highlight in this very uncertain time where we are. And, unfortunately, it's very difficult, but we are no different than any other CEOs in the country. In fact, they have a CEO uncertainty index. So the Fed goes through and does what's called a beige book. They go through and they ask all of the CEOs throughout the United States, and they take data and figure out what the uncertainty component is. Right now, the CEO uncertainty index is lower than the lowest part of COVID. So CEOs are just, they're not spending money. They're not hiring. They're not firing. They're not producing stuff. They have no idea what to do in this environment until they know the rules of the game. And as you know, the rules change every day. We saw yesterday about maybe Chinese tariffs wouldn't be, you have no idea. So with this uncertainty, that causes less growth. And then in fact, if the tariffs come through as anticipated, we're going to have a higher inflation. So big picture wise, I just wanted to kind of preface what we're looking at on the next 6 to 12 months and go from there. So with that, before I introduce Becky to go over performance, I'd stand for any questions.
Mr. Chairman. So you had mentioned, so worst case scenario, given, those points, 1.6 billion. I mean, but any type of shot in the dark of knowing how conservative we've placed a portfolio, what that would look like, how much less?
Well, yes, Mr. Chairman. If we 20% down in equities. So right now, the forward PE on the S&P is at about an 18 PE, which is at the 81 percentile of expensiveness. So even where we are now, the S&P 500 is extremely expensive. So, Madam Degenfelder, with the 20% downside that we're saying, that would only take us down to about between 42 and 4,400 on the S&P. We're about 5,300 right now, so we're not even down to where we could go. Could this go much further than that? Absolutely. So what I'm saying is worst case scenario under those assumptions. But as you know, if we go back to look at recessions, just the typical recessions, we're 12, 14, 16 PEs, I believe, over the last 3 recessions. That could take us down significantly further. In S&P terms of declines, you're talking about 33, 50. It was either 33, 38, 50, and 58% declines. And so we're not even close to where we potentially could go if this thing gets ugly. And it's clear that foreigners are repatriating money. And with a twin deficit that the United States is holding, it is really difficult to borrow money because that's what you have to do. We have a 7% budget deficit, and we're telling our bankers, we're not nice to our bankers. The people who are lending us money, we're forcing them to have tariffs. So that financing of our deficit could be more problematic. And as you know, higher rates. So that's kind of the downside. But then the upside of it is, all of this could go away. We could have a very legitimate tariff because, why can Europe sell cars into U.S. and no tariffs, and we can't sell cars? Same thing in Japan, as the governor knows, where he is. It's not fair. So hopefully we become a fair trading world and everything is fine. So that's the best case scenario. But the pundits are saying, as I said, 50% probability of a recession over the next 12 months. That's kind of the scenario that we're looking at, and taking an average decline of 20% and so forth. So under that scenario, that's where we are. I hope that was a long answer to a short question.
Any other questions out there? Anybody on Zoom? Nice to see Tom and Celia and Ken, Kathy, Doug. Thanks for showing up there.
Good morning.
Morning.
Yep, Mr. Chair, can I make one comment?
Certainly.
Yeah, I mean, the only thing I would like to say to the group is clearly we are in a bit of a scary time in the financial markets, but one thing that we do need to remember, and I think it's the resilience of the investment team, the IFC, you all, is that having a diversified portfolio. I mean, we're seeing sort of opportunities in the emerging markets. We're seeing real asset plays. So there are actual opportunities. And again, what's critical is the asset allocation, as Patrick mentioned. So I think that's one thing. Just let's not kind of get too panicked here, in the sense of that, again, this is the advantage of having a diversified portfolio that we've always talked about.
Thank you, Tom, for making that point.
Mr. Treasurer, Mr. Chairman.
Mark.
If I may, I think the point here is that the sky is not falling, that there are opportunities, as Tom has said, and that I think there is the chance for a real challenge coming. Having a diversified portfolio is not a bad thing, and it does give us the option of being able to lay some groundwork as we go forward. So I think this is actually an interesting time, especially for this asset allocation discussion.
Go ahead there, Secretary.
Well, Mr. Chairman, Mr. Fleming, I take it you're not a huge fan of the administration, but I guess, one thing I'd like to ask you on that is, have you done a calculation on the current status of our trade deals, the one-sided nature of them, and the downside effect on our country's economy in the medium to long term if we do not reverse the ship that was put in place by this sort of Clinton-Obama situation over the last 2.5 decades and the poor negotiations they covered that were really inconsistent with free trade and capitalism. Have you done any analysis on how not pushing back on that, what the medium and long-term effect of that would be?
Mr. Chairman, Secretary, great question. And that's what I was trying to allude to, is that the current trade situation is extremely one-sided. I just made in Japan, we can't sell California rice into Japan. We can't sell why? It's not fair. So from that standpoint, I'm not talking about, that what we're doing is not correct in what the goal would be. I'm talking about the method to put a massive shock onto the global economy, as opposed to doing something more less egregious to the economy, and trying to do it in a more diplomatic, effective way, instead of just saying, no, we're 45% to 120% tariffs, 45 on everyone, as opposed to just doing, okay, each country, we're going to have negotiations with you. Here is what you're doing to us, and this is what we'll do to you unless this is remedy. So from that standpoint, it was just the method that created this massive uncertainty that could potentially throw us into this stagflation environment if it continues. The amount that it's the benefit to the U.S. worker, we have studies of when we have done this and we've put tariffs, and in the 70s and 80s, the average income across the board increase to the U.S. workers averaged 2.5%. So that the benefit of that is 2.5%. The manufacturing side, when you look at all of these beige books, read the beige books and you can see the manufacturers from all over the world. They are saying that there's a eyeglass manufacturer in Japan. I was just trying to be consistent with the Japan theme here or whatever, that said that he cannot get the workers in the U.S. That's why he started his production in Japan, because he cannot get the skilled workers to do the eyeglasses. And he said it doesn't matter what the tariffs are, we cannot move our production back to the U.S. So there's going to be a significant amount of manufacturing production that is not going to be in the U.S. You're not going to produce shoes in the United States. So there's all different kinds of things that will be precluded from bringing manufacturing back. So to say that I'm not a fan of the administration, I was not a fan of the way they handled the situation with what they're trying to do to create a fair trade balance. Because what we have now is not fair trade, no question.
Well, and Mr. Chairman, I just think it's really important to note the administration has a great plan on this, and we can't just sink to just assuming the lowest common denominator and saying that we're not going to be able to repatriate and do this manufacturing. But this is a 2.5 decade process that we're trying to bring back to what indeed is fair and consistent with free trade, and move our economy back to what is consistent with free trade and capitalism, which is having an economy that across the board works, not just for the Harvard insignia on your mug there, but one that works for the entire American population. And so that's I think what the administration is working really hard to achieve, and I think they've got a plan, and it's really important to note that. So thank you.
Well, I just quick, as we're kind of talking, I guess, politics, philosophy, and everything else. From my perspective, I want to think that the glass is half full instead of half empty. And if you look at it from there, there's an opportunity. I mean, China has to pay $5 in tariffs for every $1 we pay them. So there's some pressure points on these folks. So I think that things will move around, and we don't want to necessarily be overreactive, but we still have to. make sure that we don't have the rose-colored glasses on. And I think that's what we're kind of talking about to start with here. But one of the things that I hope that we can look at is looking at the onshoring that could occur and the opportunities that Wyoming could have. And we're going to put about $1 billion into play here over the course of the next year or so from rebalancing. So, trying to find partners that will actually look at industries that we may be able to do in Wyoming. Look at the trony industry and see if there's anything that we can onshore there. Look at our strengths, play to them, and try to leverage our investments in a way that will actually make the glass all the way full for Wyoming. I'm not so sure about some of the other states, but I think if we really concentrate, we can come out on top. So with the glass being half empty and half full, understanding some of the worst case scenarios, I think we've constructed this portfolio with the CIO this year and our team to actually be what probably I would say that the highest performing, although maybe not the most profitable ourselves, but the highest performing in our peer group this year. So, yeah, Patrick.
Yes, Mr. Chairman. Yes, just to be clear on the downside deviation, whenever we look at a trade, just so all of you knows, when we look at manager selection and so forth, the first thing that we do is we look at the downside. I never look at the upside. The upside is going to take care of itself. How much can we lose? That is always what we're trying to focus on. So I've had numerous calls from many legislators, saying, "Oh gosh, what's going to happen to our fund? Are we going to have money? Are we going to be able to make our spending policy?" And I was like, "No problem. We're good. We're good." And they said, "Well, people are asking me, can you quantify what it is?" And I said, "I'd give you the scenarios because we have this very high tech risk system." And so that's what I was showing. But on the upside of it, we're way underweight some of these assets that we've just been doing this pacing schedule. If we're down 20 to 50% in equities, we're going to be buying. This would be an unbelievable opportunity for us to buy. So there's always the opportunity set. So that's something, that I'm, very, very attuned to. And, as far as, being attuned to the people of Wyoming and so forth, I'm a third generation Wyomingite. Unlike, many different people in the state who've moved here recently, I'm really in tuned to the people of Wyoming. And that is why I'm doing this, is because of the people of Wyoming. So, that part, I think I'm really well versed about understanding, what is the benefit for the people of Wyoming. Thank you.
Becky, let's go ahead and take a look at the numbers here and kind of.
Mr. Treasurer, before you do that, if I may, it's interesting, the conversation here with perspective on Japan. Earlier today, Governor Lujan Grisham and I met with the Prime Minister, and the point that he made was very much that these tariffs are very much on their mind. In 1980, trade deficit to the U.S. was about 70% Japan. It's now less than 20%. But I will tell you that they are very eager to invest in the United States, and they are very, very eager to get energy, which is part of the conversation we had, is to get energy off the West Coast, so it doesn't take 40 days. It takes substantially less to get to Japan. They are eager to make those investments, and they are eager to get our energy. Both of those things, I think, bode well for the opportunity set we're talking about.
Okay, thank you, Governor. Okay, and I see no more hands. Becky, you're
All right.
on. Thank you.
Well, good morning, everyone. Mr. Chairman, we have issued just in the last couple of days a flash report through March to give you the most current numbers we have. But as you know, in looking at the markets every day, that just changes dramatically. Investors hate uncertainty. Markets hate uncertainty. So we've seen some positive lift in the domestic stock market the last couple of days, just on the relative optimism or less optimism about the tariff situation and making progress. So through the 22nd, just to give you some numbers, the U.S. stock market was down about 10% year to date. The international developed world is up about 8%. So one of the things that you have done extremely well as a SLIB and IFC, the Treasurer's Office, is create an asset allocation that, as we were hearing, is going to be much more resilient in these kind of markets than many other peers. So we're very much encouraged by that. So knowing that this snapshot is old relative to all the market volatility, at least we'll give you some trends that we're seeing. If you turn to page 3 of this report, through March, our assets are almost 31 billion, as you can see at the top, if we add together all the different funds. And the 3 largest funds, the Permanent Mineral Trust Fund at about 38% of those assets, the Common School about 19%, Workers' Comp at about 9%, and the State Agency Pool about 19%. And of course, we'll be talking about asset allocation for all of these funds, but just to give you a sense of the relative size. If we look at performance on page 4, again through March, you can see the different timeframes here, the quarter to date numbers. Even though the stock market here in the US was negative through that snapshot, you had a positive return for the quarter if you combine all of those funds together of about 1.7%. The fiscal year to date up about 5%. So again, some good returns there. Right on top of the index, just slightly behind it, as you can see, by 20 basis points. Then the longer term history of about a 5% rate of return for those longer periods from 3 years, 5%, 5 years, 7.5, 10 years, 5%, as is 15 years and 20 years. Now, remember how different some of these periods looked as we were going through the COVID crisis and other corrections we've seen in the marketplace. And yet these are all captured inside of these numbers. So hopefully as we move forward and as the tariff picture and all the related conversations about that and inflation, as we'll talk about in the asset allocation, hopefully over time, we're going to prepare for the periods that we were talking about where equities could really correct significantly here in the US. But over the long term, we really do believe the structure that you all have put in place will serve Wyoming well. The fiscal year-to-date returns, if you look at by asset class, is at the bottom of this page, just underneath the summary at the top. One of the things that may just jump off the page, and again, this is fiscal year-to-date through March, is just look at some of the diversification. If you look at what MLPs have done for this fund in just this fiscal year, a very volatile asset class, again, involved in energy transmission, up about 25%. This is just a demonstration of some of the diversification that you do hold that will help us during these periods when there's so much focus on just the US equity market. And we've got many other asset class tools, and you can see their relative results. Another one that has certainly been a topic of conversation in past years has been emerging market debt. That actually has been in positive territory here. Fiscal year to date, a return of 7.8%, and has a great yield, which we love as we look at the needs here in Wyoming. So the various tools that we have variable performance as we look at the absolute level of return that they've been generating, but they're all very important tools in your overall structure. As we move a couple pages past to page 7, you get a sense for how the individual funds have performed. I'm going to be concentrating on the fiscal year-to-date numbers, which is right in the middle of the page. And basically across all of your funds, you have about a 5% rate of return through March. So 5% for the Permanent Mineral Trust Fund, the Common School account of 5.6, Workers' Comp Fund at 5% at the total fund level. On the following page, the fiscal year-to-date return for LISREN, the total, including that long-term reserve and short-term reserve, up about 5%. Pool A, almost 6%. State Agency Pool, 4.2%. So again, very consistent types of return observations in this very interesting fiscal year-to-date so far through March. Looking at risk, which is very important to evaluate, not only as we look at environments that we're in, but over the long term. On page 9, you can see our goal of having all of these funds with less volatility than a 70-30 mix of global equities and US bonds. That is in the dark purple line, you can see that all the funds are significantly below that line. A lot of funds that aren't as diversified as Wyoming is and have much less in other asset classes, even just less in international equity, are going to experience the full volatility of that 70-30 and the U.S. equity market correction that we've seen. But because you're more highly diversified over time, you have less volatility, and we would expect when we do the evaluation through even more current days, much less volatility than other peer funds. When we look at that volatility as a percentage of the 70-30 benchmark indication of the risk that we'd like to take overall in Wyoming, the chart on the following page 10 shows you that percentage. And when you look at where all of these colored lines are ending up towards the end of the year in the last quarter, we really have been experiencing a level of volatility relative to that benchmark 70-30. That is 70% or less of the volatility of that benchmark mix of global equities and fixed income. So that is certainly great news and exactly where we'd expect you to be given the asset allocation that you have. The risk-adjusted excess return and Sharpe ratio on page 11, you're also doing very well relative to that 70-30 mix. And so not only are you controlling risk, but your return relative to a risk-free rate has been performing very well too. So as we go into these conversations today about asset allocation, this snapshot is just giving you an indication and proof statement that the overall structure continues to work well for the state of Wyoming. But we never rest on our laurels and assume that what we have is always going to be appropriate for every environment. We take a fresh look at that today. We'll be going through that analysis today. But even in light of all the volatility that we've seen over the last few weeks, we still believe that diversification is going to continue to serve us well. So those were just the few comments on the flash report through March that I'd like to offer today.
Any questions from anyone? On Zoom first? Okay. Anybody, any of the panelists here, guys? I don't see anything. Well, Becky, you were very succinct, evidently, and informative, because we don't have much to say about that. So we do have a lot less risk. Think there's going to be any opportunity? I guess, I think Patrick talked about it, that we'd probably be going up in risk if the stocks got lower enough. We'd end up adding a little more on there. So we've got quite a little bit of headroom. Most of these are in the 50s, not just the 70s. You only got one that's over 60.
Right.
So it seems like that we've got we're kind of primed. I think we've got some dry powder as far as actual cash on hand too. So
yes, that's true.
So how just you don't have to tell us, but how low can it go? If you do you think it's time to pull a trigger in the 4,000s, or should you wait for it to go lower? Or you think that I see that even though our president has an interesting way of negotiating, it seems like he's able to pivot and take the sting out of these things, like he's done in the last few days. Do you think we're going to find a kind of a bottom or a happy medium here and move on? Because it looks like the negotiation tactics was shock and awe, and then, okay, let's get you to the table now. So
yeah, Mr. Chairman, I think you've described it well. That the big hammer approach or the shock and awe approach, certainly with the big numbers that came out in the beginning of the tariff conversations, seem to be part of the strategy and encouraging everyone to come to the table and start talking and negotiating those tariffs country by country. Now, it's interesting when you look at the days that the market has been up during this period, it's been when there's been a relief of a point of concern. But there's also been some false starts with some of the optimism that maybe China is at the table, and then clarification that not quite yet. We haven't started talking officially with China yet on the state of their tariffs. So The volatility that we're seeing is not surprising at all, given kind of the rollout of the tariff program. We all knew from the platform of before the elections that this was going to be part of the equation, but because we're not familiar in the modern day environment with how to think about tariffs in this new way and this new source of revenue and having it be such a big adjustment, it was hard for investors to navigate that. Now, what decisions has Wyoming made that is certainly beneficial in this period? Not only the level of diversification, but we're going to talk a little bit later today about that when the asset allocation targets were set, there was a program to get to that target allocation over time. We did not immediately go out and buy a bunch of equity or other volatile asset classes just to get to our target on that day. Actually took quarter after quarter, a couple of years to actually get to that point, and that in the long term will show to have served you well. Now, obviously, looking at cash levels and any further distance to go to get to those target allocations, as Patrick said, it's a wonderful time to actually think about buying opportunities because U.S. stocks are off their highs. But one of the things that is easy to do is to forget about the 2 years we just finished in the U.S. stock market with returns of 25 and 26%. Unrealistically high returns on a narrow set of stocks. So in a way, any kind of shock would have led us into a volatility that may seem probably bigger than normal, especially if it had the impact of impacting technology-oriented stocks, which really dominated the market results over the last couple of years. So yes, it is a great time to think about, again, not just counting on the volatility that we've seen in the lower prices in the U.S. equity to just true up immediately, but it certainly is an opportunity to say, hey, can we continue and finish that progress to our target allocation, given that stocks are on sale, if you will. Now, that doesn't mean that volatility is going to end. There's a lot of things we have to navigate. You probably saw that the IMF came out this week with estimates of global growth as a result of the tariffs that have been put in place. And really the outlook that they gave is that globally, global growth would be less by 50 basis points, 0.5% due to tariffs in the current year. And in the US, closer to a decline relative to earlier expectations of almost 1%. So growth is slowing. And of course, the issue is, can this teeter-totter avoid stagflation? That is going to be a concern. And what will the Fed do? So investors have a lot of things to look at, including whether the Fed is going to reduce interest rates to stabilize markets and investor sentiment. The problem is, and we'll talk about this in our asset allocation assumption discussion, is that tariffs have a near-term impact of inflationary pressure. But in the long term, it can actually affect consumer spending, which is a deflationary impact. So the Fed is worried about keeping unemployment at a level close to full employment where it is today. But also, we're just coming off a high inflationary period. Now we have this shock to the system. Do they react now, or is it too soon? And of course, the pressure between the presidential branch and the Fed is really high right now. Fortunately, we've eliminated that threat of whether Powell was going to be pressured out of office or terminated. That's been clarified. Markets like that clarification. That's going to be a very tough job for the Fed to figure out when to reduce interest rates or when to stay steady. And right now, they have not done anything with interest rates because we have inflationary pressures in both directions right now. So long answer to your question is it's a great time to continue dollar cost averaging.
Okay. All right. Thank you.
No? I am. You're going to be tired of me today, Mr. Chairman. All right. And Joss is going to join me when he can, when we can talk more specifically about Wyoming and the asset allocation plans. But in that presentation, we actually introduced this section with our capital market assumptions. One of the hardest things we have to do is to get together at RBK and talk about expectations for asset classes in the long term. But given the data through the most recent year and all of the history for the relevant asset classes, because one of the inputs into the asset allocation discussion we're going to have today is that you do need to make some forecast about what we can expect from markets. And to that, we add the needs of Wyoming. To that, we add diversification goals and a number of other inputs. But we start with these assumptions. And this year, obviously, we did this back in January and finished February 1st. So we had some volatility that we are familiar with. We are just coming off of very strong equity markets in the US and looking at inflation continuing to come down. So as we look ahead to 10 and 20 years, these are some of the conclusions that we came to. They are summarized on the themes for the 2025 capital market assumptions. And you can see, first of all, that we did not move our inflation assumption. This is something that we look at every year. I'll show you the details of that in just a moment. We actually think that there are pressures both on inflationary upward movements to that number of 2.5%, but there's also long-term deflationary pressures, and we talked about them, a few of them just a moment ago. So we did leave that constant for a 10 to 20-year period, recognizing and in our modeling for inflation, we looked at what would happen if inflation was higher in the first couple of years of that sequence of measurements. So we did leave that the same as your last asset allocation. We did have to, though, when we looked at the price of equities, and Patrick mentioned the PE numbers were a very high percentile in terms of relative to history. We did have to shave some expected return primarily from U.S. equities because they have been so expensive over the last couple of years. So in other words, we've been more conservative as we look at these assumptions, and we just don't assume that the frothy U.S. equity markets are going to continue that pattern. And boy, this year has been a good reminder and lesson that volatility happens. So we did reduce some of those. And then for fixed income, it appears that interest rates may be higher for longer. We have better yields than we have had in the last few years. That's a great thing because fixed income pays income to Wyoming. We actually increase the expected returns for fixed income generally. So that the impact of all these changes actually means at the end of the day that when you look at a diversified portfolio, the expected return for those diversified portfolios didn't move a lot this year given these assumptions because you had equities going down a little bit, bonds going up a little bit, and inflation the same. Just a reminder, on the next page, we show you the building blocks, how we build asset class assumptions. We've talked about this in past years. We actually go through a process where we build those expected returns. And the first thing we start with at the top of this page is inflation. We add to inflation any income element for the asset classes. For equities, it's dividend yields that you add to inflation. Then we add real growth to those two elements in expected returns. And in the case of equities, it's earnings growth. What do we expect from the earnings growth of companies? And then to that, we have either a plus or minus adjustment relative to the relative price for that particular asset class. And in this case, the relative price of equities had us move that expectation down in the long term. So we use a building block methodology for many asset classes that you use here in Wyoming that's based of those components. We have a few asset classes that are private expressions of public market investing opportunities where we may take, for example, private equity. We look at the outlook for equity generally and say, we need to earn more return in private equity because of that illiquidity. And by the way, we think that the managers and the process of building value in private equity is going to give you more return than in a public market company. So we have a spread methodology we use there where we add additional return on top of what we expect from equities. So we have a couple different methodologies. There's actually many models for every single asset class. The whole firm is involved in this effort. Josh and Joe and I are all involved at some element of the process. And at the end of the day, the whole firm debates and adopts these asset class expectations. Now, what's important on the next page, one important component for Wyoming is yield. What kind of natural yield are we going to be harvesting from these portfolios to feed the spending policy needs? And as we look at the middle of the page, that's the yields that were in place at the end of the year for the asset classes that you participate in. These are important. We just show you relative to year over year, were there any changes in those outlooks? There were some small adjustments in the case of some asset classes, larger in others. But at the end of the day, the December 2024 yields is important. And when you look at equities, U.S. equities specifically, there is some yield, which is great, but we're primarily investing in them for capital appreciation. International equity, one thing a lot of investors don't realize is that international equities actually pay more dividends than the U.S. And that is certainly a benefit in your structure. And you have, as Josh will review, a robust allocation to international equities. And this is one of the advantages. MLPs, we just showed the strong returns that you've had fiscal year to date in MLPs. They also have a very nice yield of almost 6%. Another standout number certainly is bank loans, private credit. These are all, again, important tools to try to forecast for Wyoming, again, because of our spending calculation and needs year over year. Just a couple of perspectives on a few of the asset classes. The next page shows public equity. This is a model that actually gets at the points that Patrick was making. When we look at the price of stocks relative to the earnings, the PE ratio for the U.S. equity market, some numbers that we looked at is that the year-end large cap U.S. valuation was in the 98th percentile relative to a Shiller database dating back to 1926. So again, these numbers will change a little bit depending on how long a time period you're looking at. In other words, the 37.11 December 2024 CAPE ratio is actually one of the most expensive marks we've seen in the history of the stock market. That certainly, as you're an investor looking forward, would make you think, I can't count on those prices staying elevated for the long term. I need to be very realistic about that. And when we look at history, when we enter a period with the beginning prices of stocks being very expensive, the forward 10-year return has been much weaker because of that starting price. Valuation does matter at the end of the day. Fixed income, or excuse me, I'll get to fixed income in just a moment. In international equity, it's not so expensive. Some of the charts below will show you we didn't change our assumption for international developed equity relative to last year. We believe it still remains appropriate. When we look at emerging markets, cut it a little bit, again, because of the relative price of emerging markets. And they have lower dividend yield expectations currently. So when we look at that, we did cut that expectation. And then fixed income, I mentioned in my opening comments that one of the adjustments we made on the following page is to increase our fixed income expectations. The lead of our capital markets group likes to say yield is destiny. When it comes to fixed income, most of your return in fixed income is that coupon or yield. And there is a very strong correlation between the yield of fixed income and the next 10-year return. In fact, it's a 95% correlation, meaning that the yield is destiny. There's a very strong correlation. When we look at where yields were when we set these expected returns, you can see at the top towards the right-hand side, the one-year adjustment for fixed income. For the U.S. aggregate was up 50 basis points, long duration up 50 basis points here in the U.S., and then low duration 25 basis points. So again, due to the better yield environment. The following page has real estate, and we did increase our expectation there. As you know, in looking at performance reports, the last couple of years have been tough for real estate. In 2022, it was one of the best performing asset classes when bonds had their historic correction in 2022 because interest rates went up so much, and we had a negative equity market as well. When we looked at real estate the next couple of years, valuations of properties were very high. And we still had the problem with downtown office buildings in major cities around the country. So there was a downward pressure in real estate prices in 23 and 24. As we look forward, we think that downward pressure on prices is really normalized, and we increased our expected return for real estate. Not only do we think prices are in better shape, but we think that the lease income is improving as well. And inflation, we've talked about that. That's on the next page. We did not change our inflation expectation at 2.5%. We have a cash expectation, a return of about, as you can see in the pages, a geometric return of 2.7 relative to 2.5 for U.S. inflation. And again, the longer term, many measures you can look at for inflation. The break-even rates between Treasury inflation protected securities that follow the levels of inflation through their construction and Treasuries, we find that the long-term outlook for inflation still is around 2.5% when you look at all those break-even numbers. So that and some of the deflationary forces that we talked about earlier, we think is over time just giving us the indication that we continue to feel comfortable with inflation staying flat at 2.5%, even though you're going to have aberrations year by year. So the next page actually shows the capital market line. One of the things that we do is not only do we study every asset class in detail to try to come up with an expectation of where we think those returns will be, we also believe that those asset classes need to relate to each other. In other words, there's no asset class with no volatility and a high expected rate of return. There's always risk involved. And we want to make sure as we look at these models and how to diversify your assets, that the asset classes have reasonable relationships to each other relative to the risks that we think you're taking on. And if we look at where all those green diamonds are and we fit a line through those relationships, you can see that that green line is shifted down a little bit relative to the dotted blue line, which is the assumptions last year. So we think primarily when we look at some of the adjustments made to equities, for example, we still expect a similar level of volatility, but a little bit less return from some of those asset classes. So the line shifted down just a bit, marginally, not a significant change year over year. So that is a quick explanation of how we got to the numbers on the next page, which is our capital market assumptions. Again, as we go through the asset allocation exercise, not a lot of change year over year relative to the expected returns for your portfolios because these changes are fairly modest. The one-year adjustments are on the right-hand side of the page. In that orange color are asset classes where we saw a reduction in expected return. As you see at the top of the page, those equity categories in the U.S. are down about 50 basis points for large cap equities. When we look at non-U.S., just a little bit of change in emerging, down about 50 basis points. In green, you can see a lot of bond categories actually going up by 25 to 50 basis points. So again, this chart just helps summarize for you the changes that were made year over year. And finally, we talk a lot about risk and return, but very important and actually very beneficial to the robust asset allocation structure we have here in Wyoming, doing the great decisions you all have made, is counting on asset classes not moving in the same direction at the same magnitude relative to each other. Diversification. This captures it in the interrelationship of asset classes, a correlation on the next page where you see all the colors. And if you look at the third column, from the left, that's broad U.S. equities. This is what a lot of investors have continued to focus on. Why don't we have more U.S. equities? Well, a lot of the volatility in your portfolios is because of equity exposure. We already talked about how expensive the U.S. equity markets are. It's important that we have asset classes that move differently than U.S. equities. Just as an illustration, all the numbers, all the asset classes, as you read that chart and go down the columns, all the asset classes in green actually have a fairly high level of relationship to what happens in the U.S. equity markets. They're not as good at diversifiers. For example, investing in international equities over the long term is going to have a high level of relationship to what we see in U.S. equities, even though you see these dislocations like this year. So when we look at other asset classes that we need in your portfolio, both for income and correlation advantages, you can see fixed income. The U.S. aggregate fixed income has a correlation of 0.27, very low relative to the U.S. equity market. And again, is a very important component. Other fixed income, similar types of relationships. So there isn't a lot of institutional asset classes that have a zero relationship with U.S. equities or a negative relationship with U.S. equities, but we certainly have a lot that have different performance patterns. And we're counting on that in the asset allocation modeling that we do. So that is the third assumption: return, risk, and finally, third, correlation that we set as we set the stage for talking about asset allocation. It's a lot of words and a lot of pages and numbers. So I'll pause there before I turn it over to Josh.
Any questions out there? None here. Okay, go ahead, Josh.
Great. Thank you, Mr. Chairman, members of the board. Josh Keevan with RBK. Great to see you this morning. If we turn to the peer comparisons page, and I know I presented this data to you fairly recently, but just want to kind of use this as a launching off point for talking about your asset allocation. And you can see here, this is as of June 30th of 2024. And just as a quick reminder, you know, green is equity-oriented asset classes, orange is real assets, inflation oriented assets, blue is fixed income or safety-oriented assets, and purple is your hedge funds, which are more sort of alpha-oriented assets. And the first thing you notice is you've got really broad diversification relative to the peer group. And you can see where you're at for the Permanent Mineral Trust Fund, as well as for the Common School Permanent Land Fund. And the Common School Permanent Land Fund historically, as you know, has had a higher income need. And so it's been invested a little bit more conservatively, a little bit more in income-oriented asset classes. Both are on a journey, though, to reach a common long-term target that you approved back in 2023. And it's not exactly the same as Alaska, but if you look at Alaska on this page, the long-term target is very similar to Alaska. And these are lined up from left to right in terms of total equity exposure. And so you can, this is kind of a good graphic to see that, you know, Common School Permanent Land Fund, Permanent Mineral Trust Fund are both on a gradual quarter by quarter journey to get to about where Alaska is. And you can see where they are. And as I think back on the sort of the long-term arc and evolution of Wyoming's investments program, you know, back when sort of more towards the beginning of my time advising this board, which was early 2000s, you know, we had a recession, we had significant market losses. Wyoming held up very well during that time period because you had a lot of capital preservation assets. And a lot of that was driven by statutory limits on how much you could invest in equities. At one point, you looked more like Montana. Montana still can't invest in equities by constitution in this fund. That's what Wyoming looked like in the mid-90s. And you slowly started to build in some diversification. But you were still pretty conservative in the early 2000s. That served you really well. As we sort of left that period of time and went through some better markets for equities, and as markets did well, equity markets did well, you sort of slowly saw your ranking sort of fade towards the bottom of the pack by not having as much in equities. And there was a period of time in the GFC where you kind of shot back up to the top, but then we saw this long period of time where equities did really well, and Wyoming's rankings sort of filtered back to the bottom of the pack. The process that's been in place for the last 5 or 6 years with the IFC and advising and the Slib deciding asset allocation process, I think has served you really, really well. Credit to the IFC who has really pushed on this idea that, look, these are long-term funds. They have a very long-term objective of distributing the spending policy amount to current citizens of Wyoming, but also to preserve the long-term purchasing power of these assets to be able to do the same in real terms for future generations in Wyoming. That requires a more equity-oriented asset allocation. But we've been in a time where we've known equities were really expensive, as Becky noted, and so we wanted to have some caution in terms of how we got there. That's why we're on this sort of gradual process to get there. And we always want to embrace diversification. When we hit the 2022, where stocks and bonds sold off, the thing that you did as a Slib a couple of years prior to that really helped you and helped preserve, you had some losses, but you were near the top of the pack. And it wasn't because you were conservative, it's because you were more diversified. You had actually gotten off having as much in bonds. You had a lot more broad diversification. You had MLPs, which served you really well during that period. You had other real assets. And so as we kind of find ourselves in another point of uncertainty here, you're really well positioned. Becky's right. We showed you last year that your peer rankings were really good, best performing of these funds in the last 3 years. I'd expect that those actually, the longer term rankings continue to improve after what's happened in this current fiscal year. I'm excited to see what those numbers show for Wyoming. But the long-term direction, even though there's a lot of uncertainty, is to continue to get to these long-term targets. Bottom line, I give you the big wind-up. Bottom line, we're not recommending any changes. We think this still serves you very well. And even though we've had a 10% correction in the S&P, keep in mind it's up about 50% in the 2 years that preceded it. So it feels dramatic because we're in it, but if you zoom out, not much has really changed in terms of levels and assumptions. So we're not recommending any changes other than continued consistent transition towards these long-term targets.
Mr. Chairman, I guess that was along your previous question too, of is this a good time to build up a little bit more in our equities? A couple percentages more of our portfolio, but sounds like that was kind of the question I was going to ask, that maybe not right now, even looking at the opportunity to buy.
And it'll Madam Superintendent, it's already baked in to happen.
Okay.
It will happen gradually. And we really like that because then it's not us as humans sitting around trying to figure out is now the time or not. I actually don't think we're smart enough to get that right. But we know if you just stick with the plan, that's better than a lot of potential outcomes.
And I think next up is transition summary.
Yeah, Mr. Chairman.
Yeah.
Just one comment that I wanted to make for the Slib. I know the governor has asked this before, but all of you also, just to understand where we are as far as our yield assessments and risk. And one thing I just wanted to highlight on 26, because this is something that I think RVK has just done an outstanding job on trying to keep our return assumptions quite high while still making sure that we have that yield, because that pays for our spending policies. So as Josh mentioned, you have common school that was really highly yield oriented. But if you look at On page 26 for the permanent funds, the very bottom estimated yield part on the 70-30, the farthest right and bottom is 287. So a 70-30 portfolio would yield a 2.87% yield, and yet the portfolio we have is a 342, so significantly higher. And then we make up for the other difference, the 5% on that. But the other part, as the governor asked about as far as our risks of portfolio and so forth, if you go up a little bit to the standard deviations, where the 70-30 portfolio is a 1210, and yet our portfolio is a 1085. So it's, as Josh mentioned, just to, kind of quantify it and look at it in numbers. So some of the things and concerns that all of you have had about our movement into some of these other riskier assets, the alternatives and so forth, we're still very conservative, and we have a lot of ability to absorb some of these downside shocks, as they mentioned. So I just want to really give kudos to RBK about going through the asset allocation and putting together a portfolio that fits the needs of the state of Wyoming. Thank you.
Okay. Any other questions, sir? Just a quick thing on inflation. It's going to be till the end of 26 until we spend all of our money that we got during the Biden years for their different programs. So, as far as inflation being a little sticky, and then the other thing is that a question is about when or if ever are they going to build enough data centers? And so if you can answer that one, that'll tell us a lot more about inflation too, because these guys use a lot of construction stuff and employ a lot of people just in the building. But if your crystal ball can tell us when they're going to stop building those things, that would be real nice.
We can move forward to the long-term permanent funds transition summary. And I believe we maybe have this in the back of the asset allocation presentation. But so if we go to, I apologize, I don't know which page number this is for you. And there should be a page that says, right behind long-term permanent funds transition summary, a bar chart that shows the allocation to growth assets, capital preservation assets, inflation assets, and alpha assets at different points in time. Does everybody have that? Yeah. It looks like this. Yeah, I believe this is not the separate tab on transition, but it's actually at the back of the asset allocation tab. Page 35, I believe.
On the web page, it's 35.
On the web page. There we go. So what we did here is we talked about kind of the way that your portfolio has evolved over the past 5 or 6 years. So we actually went back to the allocations to, this is high level, simple allocations to assets that are expected to provide long-term growth, assets that are expected to provide safety and capital preservation, assets that are designed to provide real purchasing power protection and inflation protection, and assets that are designed to provide uncorrelated positive returns, so uncorrelated to what's going on in capital markets. And the pre-IFC target is simply intended to sort of mark a point in time where you really sort of started on this journey that's led to the portfolio targets that you have today. And so just starting by comparing the green and the yellow, that takes you on the permanent mineral trust fund from where you were back in 2018. This was 2018 versus where you actually are today. And you can see that generally the shift has been more growth assets, less in safety assets. And inflation assets up a little bit, and alpha assets really haven't changed. The blue is the long-term target. So that's the distance we have still to cover on this journey to these long-term targets. And I'll go into the details of the plan for getting from yellow to blue in just a moment. But you've made a lot of progress already. And as you'll see, this even though you've increased the growth assets, the way you've done it and the way that you've decreased the capital preservation assets is leading to really good returns in a very turbulent time. The details of that transition, we actually started on this path back in, even though it goes back 6 years, the current targets were approved back in 2023. So you can see some quarterly markers here. And this is just a lot of the nitty-gritty detail on quarter by quarter how these targets are changing. And these are the targets that your investment staff is being benchmarked against. So this is what they're managing to. And it's just gradually increasing towards those long-term targets. Now, the reason it takes so long to get there is because we are allocating, what we're trying to increase is generally private markets, private equity, private infrastructure, private credit, and it's not really prudent or even possible to go out and just get there tomorrow. You want to do that with some good vintage year diversification and some pacing plans that get you there over time. And so you can see what that looks like in terms of the plan. You can also see the grayed out areas. That's sort of the ground we've already covered. And in fact, when we show you the March 31st report, we're already actually ahead a little bit. That kind of 3/1/25, that's actually the current target that's reflected in the reporting. Now, the income focused funds on the next page, as I mentioned, they started a little farther behind. Because they had more of an income need, still have more of an income need. But one of the things that has allowed these funds to start moving to the same long-term target as the Permanent Mineral Trust Fund is the expansion of the reserve funds. So you used to have these smaller reserve funds that were held basically in cash. Those reserve funds are designed to help fill the gap when natural income from the portfolio isn't high enough to meet the spending policy amount. And because they were relatively small, they were invested very conservatively. Now, as your legislature has approved growing those reserves, you've been able to start to move those reserves towards a more long-term return oriented approach. It's not as risky as the long-term funds, but it's about 50% equities, 50% fixed income is the target you're moving towards there. That's designed to be, larger reserves that can contribute more to return. And because they're larger, they can be invested with a longer term horizon. The potential demands on them in any 1 year won't be as great as a percentage of the reserves. That's why they can take more risk. So the income focused funds are now on the same journey. Not quite as much progress from 2018 to these long-term targets. That's just a function of they've kind of started a little bit later in this process. And the process to get from current to long-term target is also detailed on the next page. It looks quite similar to the Permanent Mineral Trust Fund. It's just a little bit more extended in terms of the time we expect that to take to get to target. On the next page, the Workers' Compensation Fund, that's been really bifurcated into two portfolios. You have a liability hedging portfolio within the Workers' Compensation Fund assets. That is a bond portfolio that is designed to closely match the expected liabilities of that fund. Your fund is well funded, so you've got that covered, and then you've got a surplus. The surplus is invested in the same target allocation as the long-term permanent funds. And so this is just showing you the same transition plan for the workers' compensation surplus portion of their fund. And then lastly, if you go to the liquid funds transition summary, in the next section, This is the transition, and this was the one change that you did make last year, was the basically going from 100% in cash to this 50/50 risk level liquid asset portfolio for the reserves. That shows you the quarter by quarter. And because these are liquid assets, it can actually happen a lot quicker. So this is the part of the portfolio that is getting to that target much quicker. And we're not recommending any changes to these targets. Again, this is just continued consistent process towards those targets. So I will stop there, and I'll be happy to answer any questions on the transition plan.
Any questions on Zoom? See anybody with a hand up? Okay, panel? Nothing there?
Mr.
Yeah.
Chairman,
Auditor.
I apologize because I ask this question like once a quarter. Tell me what is in core real estate again versus non-core?
Mr. Chairman, Auditor Racines, core real estate is characterized by sort of really established properties that are really well leased. You're looking to basically own properties that are well leased and collect income from rental payments. Leverage levels are quite a bit lower than non-core real estate, typically maybe 30% leverage on those portfolios. Non-core real estate is actually a much broader sort of group of strategies, but generally you're talking about higher expected return, higher risk investments. Something like value-added strategies might be buying properties that are somewhat distressed and putting some money into rehabilitating them. And by doing so, growing the rental income from those. And so there, the return is partially it's rental income, but it's a much greater percentage relative to core that's actually from appreciation of those assets through the work that goes into them. And then beyond that is opportunistic, which is an even more aggressive, more higher return, higher risk real estate strategy. Value added and opportunistic together, we generally call non-core.
It doesn't have, sorry, follow up. It doesn't have it has less to do with area of business.
Auditor, it really more is designed to describe where it sits on the risk return spectrum within real estate investing.
Yes, Mr. Chairman. Auditor, Mr. Chairman, Auditor, were you looking at the breakdown of that component between the office, multifamily, industrial, retail?
Perhaps that could be what I'm remembering. Yeah.
Okay, so those are the four subgroups. Office, multifamily, which is your apartment buildings primarily. Industrial is what we're overweight. Robin's done a great job of getting overweight, the best performer on that one. And then retail.
Okay.
Which is the one that's, so office and retail have been the worst performers.
Thank you.
Don't forget malls from a long time ago. Any other questions? Thanks, Auditor. It's good to have clarification on some of those things, so everybody is on the same page. So thank you. Moving on. Yeah, let's see. The only thing we got left is a cross action on this one here, but yeah, we can take a 10-minute break and then we'll come back in with cross asset monitor. So it is 9:20. Be back at 9:30. Everybody's online out there in Zoom land? All right. Okay, we'll call back to order. And the next one that we're working on is cross-asset monitor. Twenty 2025-0303. STO. Okay. Patrick, who have we got teed up on this one? Yeah.
Thank you, Josh. Yes, Mr. Chairman. The one thing on that we did just to talk with the IFC and then with all of you is just understanding kind of the valuation metric. And, when, the secretary was talking about, so it's understanding, some of these different facets. It's not that we just come up with these numbers. We actually have, 3 PhDs back there, one in particular that puts together all of these different data for us. So we have every week we look at this data and, they're both on, kind of a 1 month or, short-term period, which we define as kind of 1 to 3 years, and then a 10-year period, which we look for the other side. But I just thought that this was really interesting for all of you to look at. And, both Becky and Josh highlighted the expensiveness of the assets, but you could kind of see on these stick charts later on, especially like going back over a 10-year period, the valuation difference of all kinds of metrics, because whether it was the CAPM that Betsy alluded to or other ones, it just gives you we look across all of these different components and kind of look at where is the market right now on a valuation basis. And, does it make sense for us to be over, underweight, or neutral weight? Many different things. Where is the opportunity set? So just really quick, just to highlight, you can look at it and kind of understand where we are on a percentile basis, both on a 1-year basis and then a longer term as well. And that's it, Mr. Chairman.
Okay, any questions on this? I see none there. I see inquisitive looks, but no questions. So anybody on Zoom? All right. Thanks very much, Patrick. And with that, I think that was a good break time. We're almost back on track now. Okay, headed to the benchmark memo. Josh or Becky? Josh?
Great, thanks.
Okay.
Yes, I'm going to walk us through this. So just a quick background. Last year, the LSO engaged another consulting firm, Makita, to review the benchmarks of these utilized in these investment portfolios, and simultaneously engaged us to do the same for the Wyoming retirement system. And this is a lead-in to the investment policy discussion, because you will see that one of the changes in the investment policy this year is a recommended change for the non-core real estate benchmark. In the memo, we actually address 4 benchmarks. The State Treasurer's Office asked us to address these 4 benchmarks: private credit, non-core real estate, infrastructure, and opportunistic. And these are arguably the 4 that are probably the hardest to benchmark, and probably where you'd find the most disagreement out there amongst professionals in terms of how they should be benchmarked. So what we've done for each of these is we've highlighted what the current benchmark is. For perspective, what we see as most common amongst our client base, both the most common and the second most common, and then also the specific language from the Makita report for that asset class. And I'll walk through these briefly and then spend a little bit more time on the non-core real estate. For private credit, the current benchmark is the Bloomberg US. It's actually the intermediate aggregate. There's a typo in the memo here, plus an expected premium of 400 basis points. So intermediate aggregate is intermediate duration, investment grade, US fixed income, whatever that index does, plus an expected premium of 4% per year for the additional risk and illiquidity that you're assuming in private debt. That is a little bit of an unusual benchmark, even for us. Our most common benchmark that we use here is a leverage loan or bank loan index, which is a benchmark that tracks tradable floating rate below investment grade loans, plus a premium of 2%, or some clients that have a little bit less risk in their portfolio don't assign the full 2%, they do 1.5%. Makita did not provide alternative recommendation, but they did note that as peer benchmarks become more robust and more available, that might be worth considering. There are some peer benchmarks out there, and I think their comment was, they're maybe not quite ready for prime time. The primary reason that we don't recommend peer groups for the private credit space are these are debt investments. When you loan money, the main thing you want to happen is to get paid back. And the problem, the downside to peer-based benchmarks is if they're performance-based, the way that managers will then try to beat that is to take more risk. And it sort of begins this, what I call the moral hazard horse race of we take more risk to beat the peers. Then you take more risk to beat the peers. Then you start sort of leapfrogging each other year after year. And that works until it doesn't. And when it doesn't, it tends to not work in spectacular fashion. And in discussions with the investment team, we really tried to understand where their focus was going to be in terms of building out this private credit portfolio. And we knew that they wanted it to be part of a fixed income asset, something that would be more immune to more resilient during economic downturns. They didn't expect it to be all floating rate. They expected to have some duration. And that's ultimately why we didn't recommend a peer-based benchmark or even the bank loans +2, because bank loans +2 is still a base benchmark that is below investment grade. And so we did say that, okay, if you're going to have a different base benchmark, we need more of a premium to try to get to the same level of long-term returns.
Yeah, Josh, one of the things that I recall in these discussions is that if you have a peer group that is an optional survey standard, then only the people who are making money say you've got 10,000 people in your peer group and 5,000 are making money. Those are the only ones that are actually reporting. And the ones that don't want to look like they have egg on their face, they don't come to the table, to say how they're doing. So you get a skew to basically even exasperating what you just alluded to, is that the peers trying to outdo the other ones, but they're trying to outdo only the ones that actually have a positive performance.
Mr. Treasurer, once you get into the peer groups, it is really important to make sure that it's one that has done the best it possibly can to get around some of those issues that can come up. So you want to see that it's consistent membership, ideally sort of independent third party that's putting it together. And it's not that we're against peer group benchmarks. We actually like them in several of the risk-seeking asset classes. We just don't really, where we really don't love them is debt-oriented investments. Non-core real estate, this is the next one. So current benchmark is NCREIF Open-End Diversified Core Equity Index. So that is a peer group benchmark. It contains the returns of a peer group of other core real estate, open-end real estate funds. So to your earlier question, Auditor, this is all of the sort of open-ended core funds that sort of stay in that sort of lowest risk, lowest return section of private real estate investment. We do think it's got good construction methodology around it. And it actually is the most common benchmark that we use for even non-core real estate, although we do have clients that have moved towards the NCREIF plus a premium of 2%. That's the second most common that we see. And this was the one asset class that Makita did make a recommendation to consider adding a value add component to the benchmark. And we think that's a good observation. The core benchmark as a benchmark for the non-core is a little bit of a mismatch because core is lower risk, lower return. Non-core should be higher risk, higher return. We are recommending that you move that to the core benchmark plus 150 basis points. This is a little bit of an inexact science in terms of assigning a premium for this. Generally, what we observe, and I believe your real estate consultant will comment on this as well in their report to you, Axia, for the sort of highest risk return portfolios, you tend to see more of the 2% premium. For the sort of moderate risk return non-core, you tend to see more of a 100 basis point premium. We like the 150 as sort of representative of a broadly diversified non-core real estate. And we also just feel like at 100 basis points, if your non-core real estate only earned 100 basis points above core for the illiquidity and additional fees and additional risk, I would be a little bit disappointed. Yeah. So that's kind of our perspective on that. These are all things, by the way, that really smart professionals can disagree on and have very wide diverging views on. So I don't want to, I'm sharing with you our perspective. I know there's IFC members that may have different perspectives. You may hear a slightly different perspective from Axia. All we're doing right now is sharing our perspective with you. Infrastructure current benchmark is 10-year Treasury yield plus an annualized premium of 350 basis points. This is, again, a little bit of an unusual benchmark. Even amongst our clients, we more typically use CPI plus a premiums. These are designed to be inflation-oriented assets. That's one of the reasons, the themes that it really is designed to play in your portfolios to provide some buffer against higher inflation. Ideally, infrastructure assets have some built-in contractual escalators to the cash flows that automatically escalate with inflation. And we didn't want to just use a bond index because the bond index is actually going to go down when inflation goes up. But we did, so we are using the yield. So it's not really something that you can invest in. It's just basically every month, whatever the yield on 10-year treasuries is at that point in time, plus an annualized premium of 350 basis points. Our perspective is it gets you to about the same place as CPI plus 4. Neither is a great benchmark. There really is not a great benchmark for infrastructure assets yet. But I would tell you that I think there's some good news on the horizon here. Even though we're not recommending a change today, we are aware of some serious efforts that we're actually somewhat party to develop a good core open-ended private infrastructure index that would function a lot like the NCREIF open-ended core index for real estate. And that is likely to be available for use sometime this year. So I would just tell you that when that becomes available, we are likely to recommend a change to that index. It's just not technically available yet, so we can't really recommend something to you today that's not actually available yet. So just a little bit of a heads up on that one. And lastly, on the opportunistic, the current benchmark is total fund returns for the funds that have opportunistic as a potential option to invest in, excluding the returns of the opportunistic investments. And this is kind of a simple concept of you don't have a strategic target to opportunistic investments. We don't think you should have a strategic target. I mean, the term is opportunistic. These should be things that you invest in opportunistically as the markets present you with opportunities for whatever reason to provide liquidity and earn outsized returns, often when there's fear in the markets, and that creates those opportunities. Our perspective is if you're going to do that, if you're going to take money out of your base portfolio and invest in an opportunistic investment, it should beat the rest of the portfolio. Otherwise, why would you do it? Makita did recommend a slight variation on this, which I think is a little bit more just for ease of calculation. which is not to use the actual portfolio returns, but to use your total fund policy benchmark. I agree that would be simpler. And we're not completely opposed to it because it should generally be pretty close. We do like the sort of purity of the idea, though, that if you're going to take money out of the rest of the portfolio, you should beat the rest of the portfolio with these opportunistic investments. So we are not recommending a change there. There's some additional data behind the memo with return data, as well as some, we think most importantly, some rolling return data to kind of show you how these have behaved over time relative to each other. But why don't I go ahead and stop there, and happy to answer any questions or go through any of the return data if that's of interest.
Just real quick, just when looking at the benchmark for building bridges and infrastructure and those things, if they're not funded this way, aren't they funded by like municipal bonds a lot?
That's correct, Mr. Treasurer, and it's actually why in the U.S. As an institutional asset class, we don't have the same level of private investment in infrastructure as you do in other countries
Right.
that don't have a tax-exempt municipal bond market, like Canada or Australia. They're not having a tax-exempt muni project. Those projects have long been funded by private investment.
Yeah. I guess, in that, I guess, light, you just say, okay, this is taking the place of a muni bond. So you just say it's the yield on a muni bond plus the capital gains tax. So just a thought. Yeah.
Mr. Chairman, this might be a question for you. So it sounds like the only change is non-core real estate, 150 basis points. So then will that recommendation go to the IFC and then come to us, or how will that process work? Oh, okay.
Let me, I apologize. Yeah, it's already been in front of the IFC and approved that. And so when we get into June, I believe that'll be a motion on the table, or do we need the approval on this one, Patrick?
Mr. Chairman, in the June meeting to change
Yeah.
any of the IPS things and so forth, that would be the meeting that we normally do to.
Right,
to
so
change
that'll just
benchmark.
flow into the IPS. We're having the IPS discussion, and then all that stuff rolls over into June for the votes.
And then Josh has another.
And
Yeah.
Again, the purpose of this meeting is to a joint working session with the IFC. So if you have questions of what the IFC thinks about these, this is probably a great opportunity for that. And I think there's also your real estate consultant, Axia, will also be on, I believe, in a moment to give you their perspective. So.
Okay, all right, clear as mud, guys? Okay, good. Yes, Patrick.
Just checking with Norm, the expert on this. The vote was unanimous on the benchmarks from the IFC. So just to double check.
Okay, anything more on the benchmarks from, I guess, in Zoom land or here? And I think you're done with the presentation, right? Okay, all right. Let's do the, is Axia report here. Do we have somebody from Axia here, or?
Yes.
Yeah.
Mr. Chairman?
Yeah.
Yes, to just double check, Mark was,
Oh, there
Mark
he is. I
Bartman
see him.
was jammed, but took time out of his busy schedule in New York to fit this in. So for all of you, as a reminder, Axia is our real estate consultant, and RBK is a generalist consultant. So, Josh and Becky et al. Are very kind to comment on the real estate, but Mark is, that is his pure focus is the real estate. So with that, I'll pass it over to Mark. Thank you, Mark.
Mark, we got a couple things, portfolio report and then the benchmark recommendation from you. Thank you.
Great. Thank you. Thank you for having me. Hopefully everyone can hear me well. As mentioned, Treasurer mentioned, we have two items, both informational. The first item, and hopefully have the materials in front of you, is just a short portfolio update report we put together just for information purposes to just talk about broadly what's going on in the real estate market. Happy to address questions. Obviously, there's a lot of movement market wide. but then review kind of what's in the portfolio currently, how the portfolio has been constructed over the years, and kind of where things stand. And then the second is just our memorandum specific to the non-core real estate portfolio benchmark that was previewed. So we'll get there with item 2. So hopefully you can see the report. If we go to slide 2 or page 2 of that report, it's just a high level kind of market commentary. So I do note this is for 4Q to 2024. So this information, obviously, kind of the market commentary's changed a lot in the last couple of months, but it really high level. If you're looking at kind of the bottom left part of that page, you can see what the core real estate market has done. The run up post COVID at 0 interest rates, and obviously the correction that's taken place since mid 22. I will also note though that the fourth quarter of 24, third and fourth quarter of 2024 were positive. First positive periods for core real estate in 2 years. And also the first quarter numbers, which we're just getting in now, is also positive. So we're 3 consecutive quarters of low but positive returns in the realm of 50 basis points to 120 basis points per quarter positive. So there is some signaling from the market that there might be valuation bottoming, at least in the core space, and a bit of a turning of the corner. Of course, a lot's changed, since the end of the year, and I'm sure it's been well discussed here, but a lot of implications from changes in trade policy, will affect real estate land. A view of higher input costs are kind of most keenly applicable to real estate strategies, and that's kind of a bit of it cuts both ways. The new supply and construction pipeline has come down quite precipitously in the last couple of years as interest rates have curtailed new developments, and that's been a rational good thing for the real estate market broadly. That new supply that has come along is being absorbed quite steadily, and so fundamentals real estate wide are actually improving and doing quite well. With a view of tariffs affecting input costs, it's just going to create an even higher bar for developers to put new product into the market and to make those projects pencil. So high level early takes from real estate market on impacts are quite negative for development higher risk strategies, but also positive from an existing asset standpoint due to the inflation protection characteristics. Higher to replace an asset will lift the value of existing assets. So the other thing that I'll say, just kind of relative to where real estate market is relative to other asset classes, there's an argument to be made that despite potential declines in growth as a result of some of the trade policies and impacts thereof in the short term, real estate really has not really recovered yet in value correction relative to other asset classes that I've seen in the last year and a half, 2 years. Public equities, of course, but even private equity and infrastructure to a certain extent. Real estate's been a laggard in the recovery. So from a basis and evaluation standpoint, real estate's actually, I think, in relative to other asset classes, in a pretty decent position. Quickly on the right side of the chart, you'll see kind of this is the sector breakdowns of core real estate returns. In the fourth quarter, all sectors were positive with the lone exception of office. Office has really been a laggard, as has been well reported, really since the onset of COVID, and really is still struggling fundamentally. But all other sectors have been up, 2 consecutive quarters on an unlevered kind of property sector basis. So a bit of a bifurcation in the market of office and really everything else performing much better. I will move along in the presentation. I'm not going to hit every one of these slides, but if we skip this to the next slide, slide 3, this is just a breakdown of the portfolio holdings. Again, so this information now is as of 3Q, so it is a bit dated, but with private markets and year-end audits and the risk data that we gather from this, it does take a while. So just one thing to note there. So it's not showing 2 recent commitments that were done in the portfolio, the IDR secondary commitment and the Carlisle Property Investors commitment, which closed in early 2025. But as of 3Q 24, there were 7 active holdings, 3 in core, 4 in non-core, 5 holdings that were fully realized and liquidated. If we slide ahead quickly to slide 5, you can see the portfolio performance relative to the current total real estate portfolio benchmark, which is the NCREIF Odyssey, as Josh had mentioned, outperformance on a net basis over the short and medium terms. The portfolio, because it has been very core focused, core and core-like focus, has really held up well since COVID on a relative basis. So the correction seen in the portfolio has been better than what we've seen broadly in the market, even Odyssey, which is entirely core. So that's really benefited the portfolio overall. Really is not a lot of development risk or leverage risk in the portfolio at all. It's really a core portfolio in principle. Moving to slide 7, we'll get a little bit more granularity on exposures. So these are underlying holding exposures in the portfolio from the property level, rounded up. The portfolio is focused almost entirely on the United States market. It's the largest market, most liquid, most institutional globally, and it's really been a focus of the staff and us in recent years to concentrate on the U.S. This concentration, 95%-ish, will increase even further as the 2 recent commitments that have since closed make their way into the numbers. That's the IDR secondary and CPI, which closed in fourth quarter and first quarter. Sector-wise, the portfolio is very diversified. Patrick had mentioned the main property groups of real estate being retail, industrial, office, and multifamily. We break this a little bit down a little further to kind of subsectors within that. But really, there's a lot of slices in this pie. The noted sizable position in industrial certainly benefited the portfolio over the last 5+ years. That will come down with the new commitments that are non-industrial focused. They still have industrial in them, but not to the extent of 40-odd%. So that allocation will come down, which we think is prudent in the environment. But going forward, we expect generally residential strategies to increase from the recent commitments. So this is diversified residential, not just market rate apartments, things like single family, build to rent housing, age restricted housing, manufactured housing, things like that, from a defensive characteristics and needs-based perspective, those type of strategies we think hold up well in all markets, but certainly in markets that are challenged with respect to growth. If I quickly move to slide 11, this just shows the kind of the quarterly on the top 2 bars and then the bottom 2 annual appreciation and cash flows in the portfolio. On the right side of the page, you can see the quarterly positive and negative appreciation in the portfolio with the annual on the bottom right. And you can see a climbing away back from up to positive on the appreciation side from the drawdown you saw quite dramatically in mid-2022. Bottom right, you can just see how steady the appreciation was really until 2021, early 22, in such a run up in 21, and how much of an outlier that was on appreciation driven really by rates going to zero, and how some of that's been given back. But if you kind of look relative to the start of 21, you're 50% up, relative to even after accounting for the drawdowns that have happened in the last 8 quarters, and still annually above that long-term trend line. So then just a couple other comments I just wanted to make, and then I'll pause for questions or comments. If we just go back to slide 3 as a visual here, it's just more comments on how the portfolio is constructed. And historically, this portfolio has really been focused on core and lower risk, core plus, and value add. Really no opportunistic exposure at all in the portfolio. And it's really been structured with perspective of inflation protection and really income generation. Net income yield out of the portfolio are around 3% right now. That's come down a bit as interest rates have been higher and more debt service costs have flowed through. But over the last 5 years, it's been about 3 to 4% kind of net distributable yield to the plans outside of the real estate portfolio, which has been quite consistent. We're actually seeing those income distributing yields tick up a bit as valuations have come down, and also as operationally and rent growth has still remained quite positive as a whole. Also, the focus in the portfolio really has been on open-ended strategies. So these are evergreen funds where the investors have more control over capital deployment and redemption in most scenarios. Recently, we've expanded that a bit to focus a bit more on this world of core plus funds. And core plus funds are desirable for several reasons. They're core in nature, but they might take a little bit added risk in the form of potentially higher allocations to non-core strategies, but more so sector specificity. Most core funds are considered diversified in that they have all of the different food groups of real estate within them in one fund. But in Core Plus, you can get more targeted. So with Real Term Logistics, that's a logistics transportation focused fund that was done pre-COVID. That's considered a Core Plus fund because it's only logistics. Carlisle Property Investors was the most recent commitment from the portfolio. That is Core Plus in nature because it's a slightly higher leverage to the tune of like 40% versus the core funds at 25 to 30, but more so because it's really focused on broader residential exposure and has no office, has no hospitality, has no retail in that portfolio. So this world of Core Plus funds we really like because that allows a little bit more empowerment to the investors to be strategic in the exposures they want, and also have a bit more, take a little bit more risk to generate slightly higher returns while still focusing on income, and not going too high up on the risk spectrum. Relative to that, I mean, if we just talk about kind of where we are today, core and non-core, core funds, which is principally the majority of the portfolio, 90%+ core and core plus, the valuation policies are most robust in core funds because of the quarterly liquidity and investment opportunities. So comparing core funds to non-core land, which are typically drawdown private equity style vehicles, you have a lot more transparency in real estate valuations. And so what we've seen in past cycles and what we expect to see in this one is core funds tend to correct quicker and recover quicker, whereas non-core funds tend to lag in valuations in particular. So as we're sitting here today, notwithstanding the last couple months, there's certainly indications that the core fund return valuations are bottoming and potentially recovering, where in non-core land it's a lot more opaque. So it's just a frame of reference of saying the core valuations we think are in a better position, and some of these non-core funds, particularly opportunistic funds, they don't have to mark to market as relevant as quickly, and there's really limited liquidity in non-core funds today with higher interest rates. There has really been no distributions in non-core funds. Broadly speaking, those drawdown vehicles are 2 to 3 years behind their normal life cycle of distributions, and so that's really hampered investor returns and really highlighted the illiquidity of those strategies, in the current cycle. Last thing I'll hit on, and then I will pause, is just talking about the recent commitments in the portfolio. So as we saw the last couple of quarters, as we saw indications that there's illiquidity both in the core and the non-core space, we were quite opportunistically taking advantage of illiquidity in the core and core plus space. And so by that, I mean we were actively looking to deploy into high conviction strategies via secondary market acquisitions. And so this allows us to provide liquidity to the investors in those funds that need it or want to get out and are willing to sell below NAV. And so there were two big investments made in the portfolio, as you will recall, where we took advantage of that, and that allows for kind of an immediate mark to par and really generating attractive returns on strategies that are long-term positions for the portfolio. One in particular is Morgan Stanley Prime, probably the top Odyssey fund historically in the market. It's a current existing portfolio, and in the second quarter of 2024, we bought a $75 million secondary position to increase the plan's exposure to Prime at a 6.5% discount to NAV, and that has proved to be pretty good timing because as I said, since the third quarter of 24, there's been 3 consecutive quarters of positive NAV growth. So you got the 6.5 bump initially, and then it's grown from there. Similarly, and actually to a greater degree, the IDR Odyssey Fund portfolio secondary that was closed at the end of 2024 was a portfolio of 4 Odyssey funds that were purchased at a 12% discount. And so that was highly accretive, and that's performed quite well, obviously, with the 12% discount being marked to NAV immediately. So those type of, I'll call them opportunistic investments, but with more core plus risk. You're taking advantage of illiquidity at the investor side and not really taking risk at the property level, if that makes sense. More recently, the Carlisle Property Investors, as I mentioned, was a new position for the portfolio, which will show up in the first quarter reporting. That's a relatively new portfolio. That's a bit of an outlier in the open-ended fund world in that they really have no redemption issues at all. They actually are raising new capital. Now there's a waiting list to get in of 2 to 3 quarters. because that fund is new. It's focused on strategic investments in residential and it's performed quite well. So we're excited about adding that to the portfolio. And recently we reviewed a deal with the IFC that is in healthcare real estate. It was an existing manager and a new strategy there, which is another very kind of low risk bond-like real estate position, which we think will hold up quite well in the current environment, as opposed to kind of those strategies that require a greater economic growth to perform. So I will pause there. Apologies, I know I said a lot and hopped around a lot, but I will pause there before going into the benchmark item 2 and address any questions or comments.
Okay, any questions on Zoom? Okay, we'll go over here. Mr. Secretary.
Well, thank you, Mr. Chairman. I want to understand off of this slideshow where we're at on these assets that took this enormous loss during the first decade of the 2000s, and then I believe the second decade. And my understanding via my conversations with you was they were offloaded right after you came on. So they were on the balance sheet when you came on, Treasurer, by a few months. But I don't know, the governor, the video's off, and the precedent when he's been chairing is that means they're not on. But I'm not saying that's correct. But I don't know if he's still on there, if he has any comments on that. But I want to understand what happened with that loss that was taken on that real estate.
Yeah, I think Patrick can probably be more specific. What I recall is that we came on and we had huge losses on the books, and primarily from a decision that one of the managers did with overweighting malls at the same time that Amazon was just starting to key off. So it was horrible timing, and that's basically what we came to the dance, and that's what we started with when I came on. But Patrick can probably give you more color on that.
Thank you, Mr. Chairman. Yeah, primarily one manager, UBS, was the manager that underperformed, and during the GFC period, they were massively outperforming. So just from a time level, is that when you were saying the timing, I just want to make sure we're talking the right time, because they did phenomenally well during that period, and then after the GFC period is when they underperformed. But when you're saying massive losses, I think the worst case loss or something was 3% Mark. You probably have those numbers from UBS, but it's de minimis as far as, massive, I would say, is much greater than that.
And GFC is great financial crisis for if you don't know what
I'm
that
sorry,
acronym
Mr.
is.
Secretary. Yeah, that GFC was the great financial crisis period of 07, 08. I should have clarified that for you. Thank you.
Period. Now, Mr. Chairman, I've always been fascinated by the timing of that. I guess it was early 2019 in the new administration, after the 2018 period. Can you speak a little bit to that? What timed the taking of the balance sheet loss?
I'm not familiar with because how we ended up with this UBS, as Mark just alluded to, that was taken out at a $12 million win for us. So when we did that trade, which I'm not sure if you approved, but the board approved, the trade for the manager, we were able to buy those assets at a discount and then move those securities to IDR at a discounted value. And now that it's marked at par, it was a $12 million profit to the fund. So I'm not sure, when you're talking about 2019, what are you referring to as far as the loss? COVID period, we had losses, but that went down and the market rebounded quite nicely. As Josh mentioned, equities are up 50% in a couple of years.
Yeah, I just remember my conversations with the treasurer from that period, that loss was taken in that period, and that affected the initial balance sheet. So, when he came on, so I thought that was kind of interesting with the time. I've always found that fascinating, but.
Yeah. And anyway, basically what Askia did, and Robin and the team, and they were able to negotiate a deal that essentially muted the losses that happened prior when we went into the new structure. And that structure will be there for a couple of years before we get liquidity one way or the other on it, but we essentially brought on board some better managers that we feel, and I think they feel, I think Mark feels that we're moving forward in the right direction. Our shop, Robin and Patrick, is basically called a low in the real estate area. So we think that these should be fairly well performing in the next few years. And that's essentially it was a way, and the way that whole thing was structured was to sweep the losses under the carpet and come back on top at an even par and move forward with better management.
Okay.
Mr. Chair, I'm sorry. Just to quantify those numbers, Josh just showed me on the report. UBS since inception return was a plus 3.1%.
Okay.
So there were periods when there was great stress and it was lower, but net as of the most recent report, it's a 3.1 positive.
Which we consider to be a disappointing positive return, but net a positive return.
Okay. And Mr. Chairman, I have some questions on the European float on the geographic graph, on the geographic distribution. What does Europe emerging mean? I mean, is that Ukraine? Is that the Balkans? Is that you could fill in a lot. What is the makeup in those assets?
Yes, Mr. Secretary, I can comment on that. Apologies for interjecting. That's mostly Western Europe exposure, so France and the UK. Primarily, there's a bit of Spain in there. There's one asset in the Czech Republic, which is as a hotel, Four Seasons hotel. But that's really office, residential, logistics, and hospitality in Western Europe in one manager.
No war zones.
And
Mr.
well, I
Secretary.
assume the emerging, I mean, France and, well, I might think France is emerging in a way, but, or at least not as developed in their economic macro strategy. I mean, UK certainly isn't, France certainly isn't. So I assume the 0.5% is what you're saying. That's just Czechoslovakia?
That's right. That's correct,
Okay.
sir.
And then, I want to understand a little more on the Asian Pacific emerging. What's in that box?
There is some exposure to Southeastern emerging Asia, very minimal. There's some assets in Malaysia, Indonesia, but most of that exposure is in Australia, New Zealand, Korea, and Japan.
Okay. And the emerging portion of that is Malaysia?
Malaysia and Indonesia, I think, will qualify as emerging.
And is there any Bangladesh in there?
No.
Okay.
Okay, moving on now that we got clarity and detail for whatever purpose, I guess we'll talk more about.
Mr. Chairman?
Yeah, go ahead.
Sorry, I have a question. I'm fascinated, it's not an insignificant percentage by the self-storage line, which I understand to be fairly lucrative. Forward looking, is there any saturation point on that? And I come from we have a limited view here in Wyoming, but what's the long-term outlook on that? How many of those can be built?
Sorry, I can't see who addressed the question, but I'll
Sorry,
address it quickly.
it was the auditor, Christie.
Okay, so it's auditor. Thank you. That's a great observation. I would say the portfolio's exposure to self-storage is limited. There has been a lot of new development, and self-storage are very easy to build. Storage has been a higher performer relative to traditional assets over the better part of the last 10 years, but development risk is certainly, and new supply risk is certainly top of mind with storage. Storage historically has really been correlated to the single family housing market. So velocity, people buying and selling homes, moving out, needing some space on a temporary basis drives demand for self-storage. There's an argument to say self-storage also has demand drivers driven by this trend of younger families and young professionals of renting versus owning, because they can't afford single family residential, so they just need more space, and so that's driving demand as well. I would say the go forward is more challenged than the past 10 years have been. Yes, there's some exposure in the portfolio, but that's through diversified exposures, primarily in those core funds that have little pieces, little portfolio exposures. We've not done anything directly entirely focused on self-storage. I think for some of those reasons that it's the performance has been quite tied to the single family housing volumes.
Thank you.
Any other questions?
Mr. Chairman, just a real quick comment. With this change in the benchmark, since we're finishing up this this piece, I just want to highlight that if you look at it and saying, okay, well, now we're moving to, an index, plus 150 or whatever the number is, and just saying, well, if that's a harder benchmark to beat, so is that something where we were benched versus a lower benchmark all this time? And I just want to highlight, to that what Robin has done with this portfolio. And thank you, Mr. Chairman, Treasurer, to say that, that Robin and Patrick called the bottom, but I had nothing to do with that. That was purely Robin. And it was pure his idea, working with Mark and Josh and so forth, but looking at that non-core real estate that has been a vast underperformer. So just to highlight that, yes, this new benchmark is going to be more difficult, but the reason that we were not involved is just because it has a terrible risk-adjusted return in the environment that we just went through. So I just wanted to highlight that, that Robin has done a great job keeping us out of trouble. But this new benchmark change, more than happy to do whatever you decide, but just to highlight that we did not have assets in that security class that would say, okay, well, here we're benchmark versus the Odyssey, and it's Odyssey plus 100, whatever you want to do. And so we were not gaming the benchmark because we didn't have any assets. He kept us out of trouble. So I just wanted to highlight that.
Thanks, Patrick. That's a good thing to know, that we can do some tilts once in a while and observe the markets and put our money where we feel it'll be the highest risk-adjusted return. Yeah. Okay, Mark, thank you. We appreciate the work that you do for us in the state and your understanding of real estate. It's good to have you on board, and we appreciate everything you do.
Thank you, Mr. Treasurer. Appreciate your time. If you'd like me to comment on the benchmark memo, I can briefly. Otherwise, I can stand by.
Absolutely. Yeah.
Okay. Yes. So item 2 quickly. We also took a look at the non-core real estate benchmark. We have a benchmark memorandum in the packet. It's informational. Not to reiterate what Josh had said previously, but really high level, there is no great benchmark for a lot of private markets, and private real estate is no exception. The NCREIF Odyssey is kind of the institutional standard, which is the current benchmark for the portfolio. Almost all of our clients utilize that for benchmarking real estate broadly. Some do utilize a NCREIF Odyssey plus a premium for their non-core portfolio. So we think it's reasonable to incorporate that into the portfolio benchmark here. We outlined some of the other options that are out there that some other investors may use. And I identified kind of the pros and cons associated with that. But it is our view and recommendation that Odyssey still is the gold standard, primarily because it's conceptually investable. It's the most transparent. You know what's in there. And that also kind of from a suitability standpoint really matches what the portfolio is currently. So our recommendation was to add a premium to the non-core portfolio. We had 100 basis points. I advocated at 150. I think either of those is reasonable. And well within the bounds of what's institutionally accepted and matches the market. So I won't reiterate all the things that Josh said, but there's a memorandum in there if you want a little bit more of the details on the non-core real estate portfolio options.
Any questions for Mark on the benchmark? Okay, seeing none. I don't see anybody on Zoom. Okay. Again, Mark, thanks for all you've done.
Thank you very much.
The next part of that is the Makita review. I think we're going to pass on that, Norm. That's been covered, I think. Yeah. Okay, good. I guess any questions here or on Zoom about passing on that? So, because I think we've just going to be hearing the same thing, Okay, great. That actually gets us ahead of schedule. Perfect. Okay, so investment policy statement, the IPS. Let's start with RVK's review of the proposed IPS changes. It's a little bit out of order, but we'd like to get, I guess, your guys' input on it to start with. Thank you.
We'll go through this memo. I think it sets the stage well for Norm to go through the details just to show what the broad changes are. So in our memo dated April 24th, we talk about the basic changes to the policy this year. We're going to be touching on ESG and proxy voting requirements, which will refer to existing legislation and statute. This is a separate memo from RVK on the investment policy. Other changes to the policy were refinement to benchmarking. We've talked about that in a little bit detail already. Restructuring the policy to refer to liquid reserves and other funds such as Pool A, and the establishment of YO-Star 3. So this has been a collaborative effort with the Treasurer's Office and RVK, and these changes to the policy have been reviewed by the IFC as well. So I'll take you through these broad sections, and again, Norm can talk to the specific details. But on section 2, under investment objectives and priorities, the first minor bullet there is within the non-permanent funds. Pool A has been renamed to long-term liquid funds. And as you know, through Josh's comments, the asset allocation policy for Pool A, it's one of several funds that will be merging into a common asset allocation. So these are going to be referenced in Appendix C in the investment policy. Within the non-permanent fund grouping, YO-Star is established. As you know, it is administering cash deposits made by state and local entities. These investments are placed in an S&P 500 equity index investment and are benchmarked to same. And these have been established in Appendix H. Under ethics and professionalism under section 3.2, this is avoiding conflicts of interest and reference to the Treasurer's Office staff. And so then again, to try to eliminate any conflicts of interest with respect to owning securities or personal interest in securities through investments, again, made in the overall portfolios of Wyoming. There are some additional clarifications and exceptions that are in the Treasurer's Office policy manual. Section 3.5.
Mr. Chairman.
Mr. Secretary.
Yeah, I'm not understanding what that means. In where we're going to grant this carve out to the to this conflict of interest, except per the office policy manual. I mean, what are we getting at here? What are they trying to achieve here? I mean, I don't know what that means. What's the objective of that?
Mr. Secretary, Mr. Chairman, may I perhaps Norm or Patrick?
I think Norm would be better versed at this. He worked closely on the compliance in our office, and Norm is essentially the compliance officer, so it's under his purview on that.
Mr. Chairman, Norman LeBlanc, Chief Operating Officer for the State Treasurer's Office. Mr. Secretary, an IPS, an investment policy statement, is typically, in my experience, a broad, high-level document that sets out the broad policy and the broad intent. It is typically not designed to be a rule book. It is typically not designed to specify at great detail exactly what needs to happen. It sets out the policy. It sets out the broad perspective. What we have found here is that we have a section of the IPS which is appropriately broad, but could be interpreted at a very micro level in many, many different ways. And typically, the way an organization with a robust compliance office takes care of this is that they take care of it via policy and procedure. So the IPS states the broad policy, and then beneath that, we transition to a policy and procedure written by the office, which contains the specific details of what that means. So when we get a question from a person within the organization about, can I do X? We don't have a gray area because they're trying to read a broad clause, but they have some very specific guidelines that tell them. Now, that is our intent. We are currently developing the policy manual, and we will have very specific conflict of interest provisions within that.
Well, Mr. Chairman, I just don't understand why we would need to revise this. I mean, it's pretty clear, and then it allows this enormous exception. I mean, it'd be one thing if it said, you know, policies need to be followed that are further laid out, but to say, you know, that they can't have a conflict except as otherwise allowed, I think is just a massive hole. So I don't know. I have some concerns on that.
Yeah, Mr. Chairman, I don't think it's that much different from the way that the Office of State Lands works, is that we have statutes, we have rules, and they have policies. And those policies, you know, have to stay within the intent of the statutes and within the intent of the rules. So, you know, these are going to basically defining the specifics rather than having specifics determined right in the rules. So, you know, it's other agencies are doing it the same way. We're doing a whole, I guess, an exercise to make sure that we have all of our office in compliant with the policies and that the policies match up with the rules. And so that's well, a lot of what the IPS changes are in here, and a lot of what our policies are going to be. And just getting and running the office in a more professional manner rather than just running with knives.
Mr. Chairman, is so a very broad, an extremely broad reading of this might be, and I'm going to say this out loud and then you can correct my thinking, might be no one in the treasurer's office can essentially own any S&P 500 because the board has directed you all to invest in an index fund. Is that what you are trying to protect against with this exception? So to say that Caleb, because I'm looking at him, can't go buy Apple stock because we have also invested in Apple stock. Is that what you're trying to get at
Through the
here, or is
chair.
that oversimplistic?
Through the chair, auditor, you're exactly correct. What we have here is a situation in which if someone wanted to take an extremely strict interpretation of this, one could not own a treasury security, one could not own a treasury bill, one could not have a bank deposit where we have a bank deposit, one could not own a S&P ETF, one could not own any security because we have a very broad holding of equities. And in fact, it is inconsistent with the OSLI disclosure process that takes place with regard to this rule, where the OSLI disclosure process allows you to simply disclose that you had those holdings, but those could then be reviewed. So what happens is that we leave staff in a position where it is impossible for them to reasonably understand what they are allowed to do and what they are not allowed to do. This is designed to allow us to then say, within the spirit of this and within the letter of this, we will construct a policy which is clear, consistent, enforceable, and understandable, which this is not.
Thank you, Mr. Chairman. I guess the other thing that jumps out at me, and I'm not saying this is a problem, but just something to think about, is that Romanet 3, ownership of or personal interest in a company which is a vendor of the state. I guess my concern there is almost everyone is a vendor of the state, because if you ask the state auditor what the definition of a vendor is, and within our system, it's anyone we've ever made a payment to. So as you're thinking about that, I would maybe, that one jumps out at me as well, for what it's worth.
I guess. As long as we're prohibited from paying sales tax, we'll just leave that one stated. Okay, yeah. Thank you for being so astute, Madam Auditor. Any further questions on that particular area, or should we proceed? I see no other further questions. Thank you. So let's proceed.
Thank you. Mr. Chairman, Section 3.5 on ESG or subsequent non-pecuniary based investment criteria, the specific language was struck in reference to the actual legislation that has been passed. And so that is the change, is to actually reference that legislation in its entirety.
Thank you. And I want to, draw attention that these rules take effect the same time that the statute takes effect. So there's no having something that the statute's doing that the rules aren't doing, vice versa. So they're basically correlated on their effective date.
Yes. Section 10, under the derivatives policy, the prior language referenced warrants are only permitted when they're attached to securities authorized for investment. But we recognize that warrants can be issued as a result of corporate actions. And so you may have the opportunity to have a warrant that is issued to the state as a result of that corporate action. And so it's just recognizing that situation. Under Section 11, portfolio guidelines and credit ratings, the policy lays out credit rating guidelines that the managers have to adhere to. And in many cases, you'll have a security that's rated by 3 agencies. At some point, sometimes there's just one of the 3 rating agencies, such as Moody's, S&P, or Fitch, that covers that particular security. This clarifies that we can use that rating even though the other 2 may not provide it. And if there is any inconsistency or violation of the limit, that can be taken care of in the next rebalancing date. Under public equity, it's also a recognition that when we have public equity security portfolios that are being liquidated, that the diversification guidelines called in the policy actually become problematic, because as the manager sells out of that security, they may end up with less than 20 securities or less. So we're just making that exception that can be anticipated in the process of liquidation. Another item under fixed income in that same section is that there may be newly issued securities that don't have a credit rating yet. And so in the judgment of the investment manager, if they believe that the credit rating that will be assigned will meet the standards of the policy, then they are allowed to purchase that security. Under bank loans, there was just a change in the name of the index being used to the S&P UBS Leveraged Loan Index. And under infrastructure, we're reflecting the investment universe of institutional assets rather than just saying properties. So again, a clarification there to make sure that we have broad exposure to infrastructure. Section 14, voting of proxies, similar to ESG, taking out the specific language and explicitly calling out the legislation that was passed this year, and similar comments that the chairman had made in terms of timing of the adoption of the policy, as well as the enforcement or legislation being enacted and effective. Under nominal return benchmarks, we just covered this for the non-core real estate area, reflecting the open-end NCREEF plus 150 basis points, so memorializing that in policy. And then again, changing the name of the Credit Suisse Leveraged Loan Index to the S&P UBS Leveraged Loan Index. And the final two components, Section 21, this is enumerating the existing legislation on the potential for, or approving local governments. Per the legislation that you see right there, were named above, have been added to the policy, and the safeguards that were drafted in policy to minimize the potential for those local governments to invade and unknowingly engage in disadvantageous financial relationships. So limitations on separate account management fees and a stipulation for best execution. Then the final item on Appendix A is just eliminating some duplicative language under return expectations, which is the goal of exceeding inflation and preserving real asset purchasing power after spending has been removed, as it's already seen in the philosophy and investment strategy section. So that is a high-level overview of the changes that have been proposed in the policy. I'm happy to take questions or defer to Norm to go over any of the details.
Mr. Chairman, where are we on getting these proxies up? I mean, I got this email in the system. I mean, are we 100% compliance? Is every single one going up? I mean, you know, what percentage are up there right now? And how far back?
Norm will handle this. He handles the proxies, and so he's probably has that information for you, Mr. Secretary.
Through the chair, Mr. Secretary, I'd like to clarify the question if I can. We are currently voting proxies on U.S. domestic securities in all of the portfolios that are either internally managed by the State Treasurer's Office or are custodied at our custodian because they're separately managed accounts. So all of those are currently registered with ISS. They're flowing through. We are voting the policy as per the recommendations from our consultant who we discussed before is very aligned with the state's wishes.
Who is this ISS? I've heard a lot of concerning things on them. What's their background?
Through the chair, there are two proxy voting firms that control 98% of the market. So that's a duopoly. And we have chosen one of those, ISS. However, we are insulated from ISS and their policy views because we have chosen to use a third-party consultant who is offered on the ISS platform called Boyer Associates, and it is their recommendations that we follow. So our exposure to ISS is their technical infrastructure, their reporting, et cetera, which are all very much top of the market. But we are not exposed to whatever biases they may have as an organization.
Now, Mr. Chairman, why can't we just hire this Boyer fellow directly?
Through the chair, let me start with perhaps the most basic. It's not offered. They're not offering direct, to the best of my knowledge. They certainly weren't when we made the choice. That's number one. Number two, they do not have the infrastructure that would allow the level of reporting, the level of transparency and visibility that you obtain when you use a large firm with a very established tech stack and reporting stack that allows you to see what is going on. And they, I do not believe, have the infrastructure that would be capable of allowing them to be used directly by an organization the size of the state of Wyoming.
Now, Mr. Chairman, I believe in previous testimony, you've said that the amount that are, that fit the two boxes that are within our purview is, somewhere around 80%, something like that, of the total proxies that the state of Wyoming is voting. Do you have that percentage?
It's still around 80%. It's approximately 81%, sir.
Okay.
And of the balance, it is one particular manager who is an international manager, who typically would not hold US dollar securities. However, we, even for our internal accounts and our separately managed accounts that are focused mostly on international securities, we still run them through ISS just in case, in that small amount that they can invest in US, that we cover that.
Now, Mr. Chairman, of that 81%, are we capturing 100% of that? Because I believe the statute pretty much requires that. And are we then capturing the other 19 that we don't control, but are still proxies cast by the state of Wyoming?
Through the chair, there are a couple of different questions there, so let me separate them down. Number one, we vote, again, just to be explicit, we vote U.S. domestic securities that are traded on U.S. exchanges, in addition to ADRs, in all of the funds that we either manage internally or are separately managed accounts, and we have custody. We do not recall securities that are on loan, and that has been our position from the beginning. So we cover everything that we own and is not lent out. We also have, for the second part of your question, an overarching process, which we will launch for the first time in July or August of this year after the fiscal year has ended, where we will go out to all of our managers and we will ask them to affirm that they have managed according to the IPS, their IMA, and including Section 3.5 of the IPS. So we will cover those that we cannot directly vote in that manner. And we cover those in that manner for any new managers by having it as part of their contract, their initial IMA.
And Mr. Chairman, who is this Boyer? Can you tell me more about this Boyer?
Yeah, Mr. Chairman, I can, and I know what some of the different quarterly things that we've had of the GOP that I've had that available, and I think you've gotten a copy of what their material aspects are, is how they vote. So, oh well, you've had access to it. I'm sorry you haven't had a chance to look at it, but I've got a copy on my desk, so you can either come up or I'll walk it down to you.
Yeah.
So, yeah, but essentially they're got in contact with them. They're very active in the State Financial Officers Foundation, and as myself and Madam Auditor are both members, because we're both financial officers of the state, and they're I would say they're probably the most respected conservative proxy manager, I would say, in the world. That's who they are.
Mr. Chairman, why does it get rolled in to the ISS product? Explain that more.
I think that has been asked and answered by Norm.
Yeah.
Is that it takes voting proxies is a commodity, and there's a very small markup on it. And so in order to get the service that we expect and you expect as far as the reporting, as Norm has said and earlier said today, that there's only a couple firms that are actually able to get that level of reporting, have that level of access to the technology. Now, one of them, there's actually three that you can get that access, and one of them is our accountant, which is, I think it's Bridgewater, but they,
Through the chair, Broadridge.
yeah, Broadridge. But essentially that would have cost us, probably $300,000. Because they are actually the people that do the accounting for the two large firms. And so essentially you get a discount because of the volume that two large firms have. And I would hope that at some point in time that we have a proxy voting organization in the United States that would have that capacity at a level that's reasonable to actually access. But these are the folks that are in the industry. It's like you can buy construction equipment from a half dozen large companies around the world, and but you can't buy it from somebody that makes it in Natrona County, because they don't make it there, and we don't have it here, and so it's just the marketplace, more or less. And I believe we've got the people that most reflect Wyoming's culture standards and in our IPS doing the jobs and doing it for a reasonable markup. I think it costs us about an extra $9,000 a year to put Boyer into that, and we audit it. And we've gotten money in this year's legislative process that at some point in time when we get a little larger, a little bit more involved in the proxy thing, we'll probably have to onboard at least a half-time person to actually keep track of that every day, or all the time. But yeah, it's on our website twice a year. I think that's what the statute calls for. So, we're complying with the statute as well as possibly could comply to. I think that goes to your point that you wanted to double check to see whether or not we are doing what the statute said. Am I correct?
Well, I'm just trying to ask some questions.
Yeah. Well, we'll give you, I think, for the third or fourth time, access to the Boyer information.
Well, Mr. Chair, I'm not sure I agree with that, but I will certainly.
Let's move on,
wait for
Mr.
that- wait for that
Secretary.
email. I got one more question though.
This dog is no longer hunting.
Let's go ahead and switch to another topic that's interesting. I want to dig into this attestation a little bit. What is the form of it? And is that in statute? Is it under penalty of perjury? And what has this been sent over to the AG for review? What's the enforcement mechanism on it?
Through the chair, Mr. Secretary, we have not completed our drafting of that attestation. It will be done in conjunction with our general counsel, Bill Pilger, and with the AG's office. And we will ensure that we meet the standards of the AG's office.
And Mr. Chairman, I mean, I guess my other question is, and July 1st is rapidly approaching, so it's going to be the enactment date on this. So one thing to keep in mind, but what's going to be the enforcement mechanism on this? Have you thought about that? How you're going to, conduct investigations, regarding different votes that come before these other managers?
Through the chair, Mr. Secretary, we have not made any final determination of what kind of enforcement there might be, but let me be clear that it is not practical to engage in a situation in which our managers feel that if they make a mistake, they are going to be sued for large sums of money, that they are going to have their reputation ruined, or anything else. So what we will clearly do is we will ask for this affirmation. We will let them know that they risk losing the account. We'll let them know that they risk losing our goodwill, which is worth an awful lot because they would like us to invest in their next fund. And we will ensure that they will quietly understand that there are consequences for their misbehavior.
Now, what are some of the wacky votes we're seeing right now? I mean, I understand a lot of this stuff is abated, but I mean, how wacky does it get? I mean, is it like we got to have X amount and,
Through the treasurer, if I may, Mr. Secretary, can you define wacky for me?
well, you know, I think.
Because what might be wacky for one person is not for another. So I'd just like to understand what you mean by wacky, and I can answer your question.
Well, what are you seeing in terms of attacks on core industries and I mean, I think it's one of those things. I think we all know what sort of the radical left has tried over the last decade and what we've I think successfully been trying to push back against. So I'll leave that up to you. I mean, I think there's a lot of documentation on problematic proxy votes over the last decade, and you know, so if your opinion is it's nothing, I guess we'll just go from there. But I think that you're kind of the expert in the space and seeing that on the ground, and I want to understand what this looks like on a day-to-day, these motions.
Through the chair, if I may. There have been some very distinct trends. So let me stick to trends. In terms of shareholder votes, shareholder matters, the number of shareholder proposals has remained at the high levels we saw last year in this season. So the number of proposals has not diminished, and that's all shareholder proposals from every part of the spectrum. However, the number of those that actually achieve even the level of votes required to be put on the ballot next year, having failed, is declined and declined precipitously. So what we are seeing is that shareholders are less likely to vote for shareholder proposals and proposals that go against management, except with perhaps the exception of governance issues where sometimes management does not want to take the correct governance move, and the shareholders will vote for that. With regard to those shareholder proposals that are designed to roll back progressive policies, those continue to run at reasonably high levels, but they continue to fail, and not only fail to be adopted, but fail to get the percentage of votes necessary to be brought back. I think what we're seeing in voting generally is a bit of a return toward the fiduciary standard and shareholders voting for what is in the best economic interest of the organization.
Anything else? Seeing there, anything out there in Zoom land? No? Okay, let's see. Well, I guess we've got through that, the proposed IPS changes. And we are actually well ahead of time. I didn't think we'd get this done, but so Norma, is there anything else in this section on investment policy statement information that we need to, or Patrick, that we need to say anything else on, or are we pretty much wrapped up there?
Mr. Chairman, I would say that we are pretty much wrapped up. I would not propose going through the black line. I think RVK did a great job in summarizing it, and I don't want to waste your time with going over typos. But I would say that there are just a couple of things I would like people to be aware of. that I think are relevant for the body with regard to the IPS. So with regard to the Wyoming Gold Act, you will see that there is not any information here about how we will handle gold. And the reason for that is that we have opted to treat it as PPI, a public interest. So we will not have that in. It is being done for the benefit of Wyomingites as per the legislation. And it is $10 million and it is out of our control. So we are treating that as PPI. Secondly,
Mr. Chairman, I got a couple questions off that.
Yeah.
You know, Mr. Chairman, you know, PPI is expressly in the code, you know, and so what is the legal analysis on how you can do that? Because I'm a little concerned about that because I'm not sure. And I can look at the act. Does it expressly refer to it being subject to PPI? And I also want to understand, I was just talking with someone the other day about this. When are we going to do the purchase? So I know I see Mr. Pilger coming up.
Mr. Chairman, Secretary, I'll answer the purchase. Yesterday, the treasurer and the consortium of the investment staff went up to Casper to review the Casper withholding area. And so we also have an internal group discussing with the acquisition of the gold in the most cost-effective way of what the cost would be, transportation, insurance, and so forth. So we're in the process of doing that and just making sure that we have all our I's dotted and T's crossed.
Mr. Chairman, Mr. Secretary, I'll keep this really quick. I mean, as far as the analysis, Norm kind of hit it. This is a specific purpose. And so, you know, we don't have any discretion and it's, you know, it's actually a dictate that we receive. So I'm just trying to simplify it, but.
I know, but I mean, Mr. Pilger, don't you think they would have outlined that in the act if they were gonna? I mean, I think that it's reasonable. They've done that in the past. You know, they've created accounts, you know, that are lending authorities to municipalities, which because of the way they're structured have rarely been used. I mean, I just am not sure I agree with your legal analysis on it. I mean, I think they would have laid that out if they wanted to say that was a PPI.
Mr. Chairman, Mr. Secretary, that certainly has been the case in some circumstances. We went through case law. I'd say it's maybe 50-50 as far as, and this is across all state, municipal, city, county, you know, different types of, you know, legislatively created investments. Sometimes they use the terminology public purpose investments. Sometimes they don't.
And Mr. Chairman, what was the process in evaluating this, the deliberative process and coming to that conclusion?
The process, we reviewed case law, we reviewed the bill itself. The bill is very brief, as you know. It states the purpose is to, you know, to promote, the purpose is for the citizens of Wyoming.
Mr. Chairman, what are the cases when the legislature did not specify a PPI where the state treasurer decided that a legislative diktat would be placed into the PPI box?
I don't have anything in front of me to assist you with that question. Sorry.
Yeah, Mr. Secretary, the differences that I see in here is that it wasn't approved by the IFC. It wasn't approved by the Slib board, and it wasn't recommended by the IFC or the Slib board or the Treasurer's office. Now, from my perspective, when I got on, I wanted to buy gold probably the first day I got in office, but I could not get the approval necessary or the advice of the IFC, and that's about as far as it went. Now, this isn't gold, this is species. So this can be silver, this can be gold. And that's what the actual, the stable token, not stable token, but the Legal Tender Act said. So it went to species. So you can do silver or you can do gold. And so if there's something that nobody in the investment area that we have doesn't recommend it, then and the legislature does recommend it, and they recommend it for the purposes in the bill, then, and if those are public purposes, then it follows that this is a public purpose investment and it's not an investment to return yield back to the citizens in Wyoming. It's a purpose to defray the possibility of inflation, from what I can understand. That was the public purpose that it's meant to address. And so if that's a public purpose, the legislature said that's what they wanted to do with it. They directed us. It wasn't a may, it was a shall. And had it been a may, then, and if we opted into it, then that wouldn't have been a public purpose. But when they say you shall do something, then that takes it out of the Slib's hands, that takes it out of the investment committee hands, and it takes it out of the treasurer's office and puts it directly in the total control of the legislature. So if it was an investment, it wouldn't be in total control of the legislature. So that I think is kind of the, for me, is the logical threads that you follow to say it's a public purpose investment. Now, you can disagree with it, buy your own lawyer and come sue us. We're ready.
Well, Mr. Chairman, that's great. We've also got, the authority through the board, so I'll take a look at it. But, I'm just not sure I agree with that interpretation. Want to understand it a little more. I'm just asking questions at this point. And never fully understood why asking questions has led to such, sort of obfusiveness by this office. But, well, I'm getting wacky. I'm just trying to lay out that I'm asking questions. So I'll continue to evaluate it and appreciate it.
IFC members want to thank you for making this a quick and easy run so far. So is there anything that you'd like to opine on? We thank you for all of your support on these efforts that we brought forth today for information. And anything you'd like to share? I think I see Cecilia up there.
Yeah, I'm still here, but I don't have anything to add. Thank you.
Okay, well, thank you. But we appreciate your guys' advice, and you're a huge part of the success of the investments in the state, and especially on the asset allocations. I always enjoy the conversations we have during that process, and I think we'll have more of them in this area. That when there's always market dislocation like it is today, there's always opportunities for some interesting lawsuits, but some great opportunities to make some money. So we hope we come up with I guess the right sauce here in the next year. Yeah, Mark. I mean, excuse me. Yeah, Norm.
Mr. Chair, at the possible risk of keeping everyone from lunch, I just want to bring up one other very brief change that everyone is aware of it within the IPS. And in fact, it's something we didn't do, but I want to make sure that this board is aware of. As you know, we had Senate File 0145, which was passed, which is the local government investing in equities. That is not within our IPS. And the reason for that is that in that legislation, it sets up the Slib to set up an IPS. It does not take any of those decisions through our IFC. It in fact encourages those local entities to set up their own consulting boards. So it is not in our process, and I did have some discussions on this with some parties within the governor's office, and they concurred that that made sense. So that would be a separate IPS that Slib would work on with the local government entities, and that would not be through the state treasurer's office, who has absolutely no input whatsoever into what the local government entities are going to do with the investment in their equities. And it was set up by the legislature specifically to give them the independence to do that and bypass the state treasurer's office. So that will be on your plate. We've sort of taken it off ours. That's it.
Yes, Mr. Chairman, just a clarification for our IFC members after this. Is your view to continue on with the IFC ASAP? Or are we just so they, before we adjourn, just to make sure that they know what we're going to do for the IFC meeting?
Well, thanks for bringing that up. I was going to address that because it's a pretty much a totally different membership of folks that are on the IFC part of that call. So I guess want to get the clarification. Are we going to continue to meet in this room? Or are we going over to number 5, or where's it going to be?
We are going into a different room. Let me get the room number for you, sir.
And I think, Don, you were going to try to get some supply of lunch for us, and okay. So let's look. When I guess what we'll do is probably try to get back into the IFC session as soon as lunch shows up. So when's that going to be?
Mr. Treasurer, we've got, there's a couple of people from the IFC that have had to fall off for a couple of business meetings, but they plan to be back for noon. So I presume that you're planning to start at noon, right?
Okay, well, that I guess we can do that. We might have to do the meeting and have a mouthful too, Cecilia. But if we're going to have people showing back up at noon, Don's moving to discuss that with Norm. Yeah. So what do you got, guys?
The plan had originally been that the IFC meeting would directly follow this meeting whenever it happened to end, so that we could get people out as quickly as possible.
Okay.
If it suits better to wait till noon because people have had to get off, we can do that. The room number is 052, by the way, West 052.
What's that?
The room at which the meeting will take place is W052. So
Okay, so Cecilia, have you got people that want to drop off and come back at noon, or can people just go from right to here and start in our meeting, and maybe we'll be done shortly after noon?
I think that because the agenda had said the IFC part was going to start at noon, you'll have better attendance if we start at noon.
Okay. All right. Okay.
That's fine with me.
All right. Well, thank you. And I think that'll we want to make sure that we've got you guys there. So we'll go ahead and start it at noon, and I'm sure we'll be ready maybe just a little bit before. Anybody on the IFC have any different opinions, or that's all Jake with you? Looks like everybody's fine with that, Cecilia. Thanks for coming back on. Okay, guys.
It's fine.
We'll be back at 12.
Okay.
See you guys.
Thank you.
And I want to thank everybody that's been in the audience today for your participation. And Mr. Secretary, thank you. Madam Superintendent. Yeah. And everybody from the IFC. Okay, guys. All right. What's that? So
To adjourn, Mr.
Yeah, we
Chairman?
move the adjourn second. Everybody's in favor. Aye. Unanimous on that one, I think. Why does Chuck have to be? But all of this stuff, he's had the Boyer thing for I don't know how long,